Good morning to everyone. Let's start the session 2 of the mock exam paper discussion targeting for December 2022 examination. Right. What we did was actually in the first session, we discussed the first 3 questions relevant to this particular paper. Right. All these things we discussed. So what I'm going to do today is I'm going to start from question number 4. So we discussed the 10 objective test questions, right? These areas have been discussed. So this is question number 3, earnings per share, discussed. Okay, right. So this is the point where we should start today. So question number 4 of the paper. So in this mock exam paper is from the professional ethics. So the ethics and the governance consist of 10% of the syllabus weightage. So usually there's a question, 10 marks question from the professional ethics if you look at the last few examination papers, right? So what we can do is let's look at the question first, right? So before reading the question, let's look at the requirement as I always say. So what is the requirement here is comment on the ethical responsibility of the CFO in respect of the instructions given to him, right? So you need to explain the ethical responsibility of the CFO, right? Chief Financial Officer in respect of the instructions given to him, right? Let's read the question. Due to COVID-19 pandemic, business of Green PLC was significantly affected and the CEO of the company, who is a chartered accountant of CS Sri Lanka, noticed that net profit in the financial statements for the year ended 31st December 2020 will be significantly less than when compared to the previous year. So what is the finding here? So the finding here is net profit in the financial statements for the year ended, this is the current year, 31st December 2020, significantly less, right? Significantly less compared to the previous year. That's not a good situation for a company. So far, Green PLC's revenue for the year 2020 significantly lower, and advances received from some customers in 2020 will not form part of the revenue for 2020 due to Green PLC being unable to produce the goods as expected in 2020. Okay, what happened was, so what is the main cause for the reduction in the net profit? As per the information given, revenue for the year 2020 is what? Significantly lower. Revenue is less. What is the main reason where the revenue is less? Because certain advances received from the customers in the year 2020, it has not become part of the revenue because company was unable to produce the goods as expected, maybe because of the pandemic. So they had to close down the operation so the planned production was unable to continue. So because of that, what has happened was they were unable to provide the goods as expected. So now advances were received from the customers right before the year end, but as the goods have not been provided, so you can't recognize that as a revenue, so that these advances to be reflected as a liability. It's a kind of a contract liability or a kind of a deferred income in the statement of financial position, which you can't recognize as revenue. That is as per the accounting standard, right? Because here it's mentioned advances received from some customers in 2020 will not form part of the revenue. Will not form part of the revenue for 2020 because unable to produce the goods as expected. CFO of Green PLC informed the CEO of the above situation. So you are the finance head, you mentioned CFO here. Sorry, you mentioned CEO. You informed CEO. Now, even though we have received the advances, as we have not provided the goods, we can't recognize that as revenue. We have to show that as an advance contract liability on the statement of financial position. However, CEO wants to maintain at least 75% of the profitability that was there in 2019. Now, what CEO wants, whatever said and done, he wants to maintain at least 75% of the profitability comparing with the last year, 2019. In the financial statements for the year ended 2020, as the company is required to meet some conditions in certain agreements with private investors. So there are some agreements entered into by the company with the private investors accordingly. So the company has to maintain certain amount of profitability. So have to have good performance in the financial statements. So because of that, CEO is saying that we need to have 75, at least 75% of the profitability of the previous financial year. Therefore, he instructed CFO to recognize the revenue from contracts with customers who have paid advances through, even though the control of the goods will not be transferred in the year ended 31st December 2020. Now, this is the matter. What is the statement that CEO has made? CEO wants to do what? So CEO instructed CFO to recognize revenue from contracts with customers who have paid advances even though the control will not be transferred by the year end. Okay, this is the this is actually the request of the CEO. So let's say you are the CFO, so your boss is making this request. What are you going to do? CEO also reminded CFO that if this is not done, his year-end results will be affected. So the year-end numbers are going to be affected. Maybe if you have profit-based bonuses, so the company is unable to, declare these bonuses, and even CFO is not going to get the bonuses. So CEO reminded that particular matter to CFO. Right. So I hope you understand the question. Now what you need to explain is what is the ethical responsibility of the CFO. You have to look at the question from the perspective of whom? CFO, in respect of the instruction given to him by CEO. Now, before moving straight away to the answer, let me highlight what are the important things that you need to know with regard to the professional ethics when you are answering to a question, because as I mentioned, always there's a question, 10 marks question from this area in the past. If you look at the few past papers, always there's a question from this area, right? So before moving to the answer, what I would say is, you know that when it comes to the code of ethics, okay, so the CS Sri Lanka has published code of ethics where all the chartered accountants are required to adhere into 5 fundamental ethical principles. What is mentioned in this code of ethics, right? You should know what these 5 fundamental ethical principles are is. Okay, so the first fundamental ethical principle is integrity, which means straightforward and honest. So as the accountant, as a CFO, when you are preparing the financial statements, you should not do any manipulations. You should not conceal any information. And also, if you think that something is correct, you have to stand on your ground. Okay, so whatever the situation is, if you believe that something is correct, you have to stand on that ground. So that is what? Integrity, right? Straightforward and honest. Then the second, I'm not going to detail, right? But what is required for the examination, I will discuss. Then objectivity, which means when you make your professional judgment, it shouldn't be compromised. So you should be unbiased. There shouldn't be any biasness when you make the decisions. You should not have any conflict of interest, right? And also you are not exposed to any undue influence. That means free from bias, free from conflict of interest, as well as free from undue influence. So your professional judgment is not going to be compromised. Okay, so for an example here, let's say you are the CFO, you are also given a profit based bonus. Now, when you make the decision whether to do what CEO is telling you to do, You can't think about your bonus, okay, your personal bonus, and make the manipulation in the financial statements, right? There you have a what? Conflict of interest. Okay, you should be free from conflict of interest when making the professional judgments. Similarly, there can be a pressure from your boss, CEO. Again, you should be free from these undue influences when you make the professional judgments, right? So that is what? Objectivity. Okay, objectivity. Then the third one is professional competency and the due care, which means you should have the correct technical and the other skills to perform your duties which would serve the organization effectively. Okay, you should have the knowledge about the accounting standards. You should know in this particular matter requirements of SLFRS 15, how to or when to recognize the revenue in case of selling of goods, right? You should know that. And also due care, you act diligently, right? For example, when you are signing documents, you have to read the documents and sign. You can't just sign. You have to act diligently. So that is due care. Then confidentiality, whatever the information that you acquire in your business and the professional dealing, you should not reveal unless otherwise you have the proper authority to do so. Okay, so you should not use any information for your personal advantage. Sometimes there can be a situation where you need to disclose because there's a legal responsibility, there's a court case. So then you can disclose, but unless otherwise that, without having the proper authority, you should not reveal information what you gather in your professional and the business dealings. That is confidentiality. Then finally, number 5, fundamental ethical principle, professional behavior, which means you should adhere to the rules and the regulations, as well as you should not discredit the profession, which means, accounting standard itself a rule that you have to adhere into. If you are a company, when you are preparing the financial statements, you have to prepare the financial statements as per the accounting standards, what is mentioned in the Companies Act. Okay, you can't manipulate. You can't say that I'm not going to adhere to the accounting standards, and you have to comply with the other rules and the regulations, maybe Companies Act, maybe if you are a listed company, stock exchange rules, right? So corporate governance practices. So you have to adhere into the rules and the regulations, as well as you should not discredit the profession. That means you should not disrepute the profession, because people respect the accountancy profession as you are a professional. Okay, you have to act on the public interest. This is one of the important things that the accountancy profession is having, because you are not just serving to your company, you have a what? Public interest. So that's why people respect accountants. So you should not discredit the accountancy profession when you are dealing in what you call in your professional or business decisions. Right. So these are the 5 fundamental ethical principles. Because it's easy for me to explain this and go to the answer, then answering to the question, I can remind these things. Right. So so first of all, you should understand, okay, what are the fundamental ethical principles. Then the second thing is, you also need to understand what are the different types of threats for these fundamental ethical principles, which means, in other words, because of these threats, sometimes professionals or the accountants act unethically. Accountants are not adhering to the above mentioned 5 fundamental ethical principles because of these threats, right? So, what these threats are, starting from self-interest threat. That means you have a kind of a financial or other interest of a certain decision. Because of that, your objectivity is compromised when making the professional judgment. So here you have a example. Actually, let's say you are the CFO, you are also benefited based on the profit figure of the company, right? So because of that, you have a self interest, right? You have a conflict of interest to inflate the profit, because that will increase your bonus as well. So that is a what? Self interest threat. Okay, so another example would be, anybody is having a self interest to protect your job. Now the accountant wants to protect, or the CFO wants to protect his job. So because of that, sometimes he would do what your boss or the CEO is telling him to do. That is yet again what? Self interest. So what is getting affected is the self interest threat. So if you look at a situation of an auditor, auditors are not allowed to keep the shares in the audit clients. Because why? Then if you have the shares in an audit client, auditor will never give a what? Qualified opinion. Because then what will happen is if we issue a qualified opinion, share prices of the company will come down and your investment value is also going to be calm down. So these are some examples for the self-interest threat. And what is self-interest threat is it? Then self-review threat, which means you review your own work. You perform the task and you review the task. Then you might miss out the things. And even if you identify mistakes at the time of review, you don't need to reveal because it's your mistakes. You are the one who has done it. So yet again, if you look at the auditing perspective, auditors are not allowed to do the financial reporting. So you can't do the financial reporting and then you audit the same financial statements because there's a self-review threat. Now, if you look at this paper, this particular paper is not about auditing, but mainly about the financial reporting. So how the self-review threat would derive in a financial reporting situation? Can you think about it? How self-review threat would arrive? Now, let's say you don't have a competent staff in your department. You are heading the finance division, you don't have competent staff. Now, what you do is because of that, you do everything by your own, being the head of the department, head of finance or CFO. Then there's nobody else to review. You review the same thing what you have done. So then you might not be able to figure out the mistakes that you have performed, or else, even though you have identified, you don't want to reveal that because it's your mistakes. So that is what self-review threat. Then advocacy, right? I explained about the self-interest. I explained about the self-review. What is advocacy? Advocacy means you represent somebody and you say good about that particular person. Later on, once you find that that particular person is guilty, you can't say like that. You can't say that he's in guilty because you represent that particular person. Example, let's say again, if I take an example of an auditor is representing one of the client in a court case and he say that client is innocent. There's nothing wrong done by the client. Then later on, auditor find that okay, he has actually done the mistakes, right? He's in guilty, but you can't tell that because you represent the client in that particular court case. Advocacy, right? Then familiarity threat, which means because of the personal relationships or might have been because of the long standing business relationship, you are very close to a person, then you are sympathetic to that particular person. You don't want to say that that particular person has done a mistake, right? So your professional skepticism is compromised because of the familiarity of you and that particular person. So then yet again you might act unethically. Example, let's say when you are working for a company very long period of time, let's say the CEO and CFO, they become very close. They go to parties, together. They go, holidays together. Then you are familiar with the other person. You are so sympathetic to that particular person. So you can't, ignore their judgments. And you don't want to say that that particular person has done a mistake. Similarly, in the case of an audit partner and audit client. So the same audit partner is auditing, let's say, the particular company for 10 years, last 10 years. So the client and the partner has become familiarized. So too sympathetic. Audit partner doesn't want to say that the client has done a mistake. And the professional skepticism of the audit partner is compromised now. Too familiar, familiarity threat. Then the final type of threat is intimidation threat. What does that mean? It can be a actual intimidation or it can be a perceived intimidation. Example, let's say, so if we take this particular example, let's say CEO might say that you have to adjust the financial statements, you have to recognize the revenue. So if not, your job will be lost. So that is what actual intimidation. You are under severe pressure, undue pressure, right? So sometimes it can be perceived. What does that mean? CEO is not telling that. He's not directly telling that, but you feel it as the CFO. You feel it. Okay, if I don't do that, I will lose my job. I will lose my job. So that is what perceived intimidation. Okay, so these are actually the threats to adhere to the fundamental ethical principles, above mentioned fundamental ethical principles for the professionals. You should have a good idea, understanding about these 5 types of threats. Okay, right. So then finally, now you identify what are the 5 fundamental ethical principles. Then you know that what are the threats to adhere into these 5 fundamental principles. Then when you have a threat, you need to evaluate whether these threats are significant or not, right? Thereafter, after making the proper evaluation, so you should actually put safeguards. Okay, you should put safeguards as a professional by yourself to reduce or to eliminate these threats up to an acceptable level, right? So once you identify the threats to the fundamental ethical principles, you evaluate the threats and thereafter put proper safeguards to reduce or to eliminate the particular threat up to an acceptable level. These safeguards have been prescribed in your profession, then in the legislation and the regulations. So the safeguards are given in the profession legislations as well as the regulatory safeguards are available. For an example, there are corporate governance practices which gives the companies, okay, you need to adhere to these good governance principles. That's a kind of a safeguard for a professional who is working for an organization. Certain safeguards actually introduced within the company, like you have a audit committee comprised of the independent non-executive directors, right? So if there's an issue with the company CEO, so the CFO can first of all maybe to discuss with the board, or else CFO can discuss with the audit committee, because that's a independent body, right? So the listed company, if you are a quoted public company, it must to have an audit committee. So there are certain safeguards established within the organization itself. And also now, to become a future chartered accountants, what you do is you learn about these ethics, and also you need to have a training requirement. You actually work in a environment where these ethics or this stuff is practiced. So the what you call this learning as well as your professional training also teach you how to adhere to the fundamental ethical principles and how to put safeguards against the threats that are there to the fundamental ethical principles, right? So this is actually kind of a framework approach to adhere into the professional ethics. I have explained maybe within 15 minutes the important stuff, most important stuff in this particular chapter. So where most of the questions are tested from, right? I hope you understood. Any questions, you can use the chat box. If you have any questions, you can use the chat box. Make sure that the message is visible to everyone, so when you are putting something on the chat box, right? Okay, then let's move to the answer to this particular question. And one of the thing I wanted to mention now in this particular question, what it was mentioned is actually CEO is a chartered accountant, right? But I think, and once institute has issued their suggested solutions, the answer was given actually assuming that not CEO, CFO is a chartered accountant. I think in if you look at the last two examination, that is the most probable question would be. Actually, I don't say that CEO. Chartered accountant cannot be a CEO of the company, but when answering to this question, actually what is more evident is CFO to be a chartered accountant. Then only you can explain that from the CFO's point of view. CFO's point of view, he has to adhere to the code of ethics issued by the CS Sri Lanka. How he act ethically, what is his ethical responsibility? I think even in the question, it has to be corrected that uh, in your so in this particular scenario, not CEO, CFO is a chartered accountant. So I am giving my answer assuming that even though it is mentioned in the question CEO is a chartered accountant, actually CFO is the chartered accountant. So just wanted to make that particular correction. I don't want to make any changes to the question issued in the mock exam paper, but when I'm answering to the question, I assume that CFO is the chartered accountant. So on that angle, I'm going to give you the answer now. Are we clear? Did you understand? Right, great. Okay, let's look at the answer. CFO is a chartered accountant, right? If you are a chartered accountant, always, if it is a ethics related question, right? So you can put this particular point. This is a general point where you can actually put into any related question of this nature, right? So if you are a chartered accountant, first of all, you should be aware about the requirements of SLFRSs. So you have SLFRSs as well as LKASs. So you know what is there, how to apply the accounting standards. You should be knowing that is a given in the profession. So when you adhere to the accounting standards only, you prepare and present the financial statements in true, which gives a true and fair view about the organization. So the CFO is a chartered accountant, therefore should be aware about the requirements of SLFRS and should apply these requirements in order to achieve fair presentation of the financial statements. On the other hand, as he's a chartered accountant, he is bound by the CA Sri Lanka Code of Ethics, right? CA Sri Lanka Code of Ethics. Is that clear with you? So these two things are what? General. For any ethics related question, actually you can put these 2 points, isn't it? You should adhere to the accounting standards to for the fair presentation of the financial statements. And also, if you are a chartered accountant, you are bound by the CA Sri Lanka Code of Ethics. Then you get into the question, as I mentioned, what is the main issue here? What is the main issue here? CEO is instructing CFO to recognize the revenue from the contracts for the advance received amounts, even though goods have not been produced and control is passed to the customer, right? You have not produced the goods, you have not sold the goods to the customer for the year ended 31st December 2020, but you have collected the advance. Now CEO is saying that as the profitability is less, as the revenue is less, recognize these advances as revenue. So here you should apply the requirements of SLFRS 15. What SLFRS 15 says that revenue has to be recognized only once the performance obligations are satisfied. So you have to understand what are the different performance obligations in a particular contract. So once the performance obligations are satisfied only, you have to recognize the revenue. In this particular case, it seems that you have to produce and transfer the goods to the customer, because in this standard, actually in SLFRS 15, there are two ways where a particular performance obligation can be satisfied or the revenue can be recognized. One is point in time, the other one is over time. Over time means you recognize the revenue over the period of time. Point in time means you recognize the revenue at a particular point in time. So what is most relevant to this particular question is actually, as it is sale of goods, right? So point in time. So what is the point at which you should recognize the revenue? So what the standard says is the point in which you should recognize the revenue is the point at which control of the goods are transferred to the customer. So once the control is transferred only, you have recognized the revenue. Now, according to the facts given in this particular question, control of the goods are not transferred to the customer because you have not produced, you have not supplied the goods, right? So you have not passed the legal title of the goods. You have not transferred the risk and rewards with regard to the goods to the customer. So the control is not yet passed, so you can't recognize the revenue. Okay, so the revenue cannot be recognized before transferring the control of the goods to the customer as per SLFRS 15. If CFO, now let's say by knowing that, because if you are a CFO, if you're a chartered accountant, you should know this. Now let's say if you knowingly about this requirement of the standard, let's assume you agree to the what you call agree to the uh, request made by your boss CEO. What is the fundamental ethical principle that the CFO is breaching in that situation if you agree? So you can answer by using the chat box. Let's say you know this, as per SLFRS 15, I can't recognize the revenue because control has not been passed, but I need to act on what my boss says. So if you agree, what's going to be compromised? Integrity. You are not straightforward, you are not honest, you can't stand on your grounds, right? You manipulate the financial statements. knowingly. So you are not a person you can consider as straightforward and honest. So you have to highlight this always when you are answering to the questions. You have to highlight, okay, these are the situations, or this is because of why this particular fundamental ethical principles have been breached, right? So now if the CFO accepted to manipulate the interim financial statements as CEO wanted, he would clearly violate integrity. Violate what? Integrity. Being honest in his professional conduct. He is not honest, right? He manipulate the financial statements. Are we clear? Right? Are we clear? Now, adding to this particular point before moving to the next point, why now I told you the fundamental ethical principle, what is getting violated is the integrity. What is the threat that he has to violate this particular fundamental ethical principles? What are the possible threats? Number one, there can be a self-interest threat because CFO has a financial interest of achieving the profit because he is also getting bonus if the profit target is achieved. So he has a conflict of interest. Okay, self-interest threat. As well as there can be a certain amount of what? Intimidation threat. Because if you don't do what CEO says, you might lose your job. Okay, so yet again, you have a self interest to protect your job. You don't want to lose your job. And from the perspective of the intimidation, yes, there can be an intimidation threat as well. So there can be an actual or there can be a perceived intimidation to act unethically, right? I hope you understood again. Then because I mentioned to you here the second fundamental principle, what is getting affected is actually this also displays lack of objectivity. Why do you say so that it is lack of objectivity? What do you mean by objectivity? Your professional judgment shouldn't be compromised. Okay, that means you should not be biased. You should not have any conflict of interest, or you should not have any undue influence by the others. Now, because of the biasness, because of the conflict of interest, because of the undue influences, if your professional judgment is affected, then you are lack of objectivity. I told you here you have a conflict of interest because you also benefit if the profit target is achieved. So because of that, if you decide, okay, I also want to have a good bonus this year. So because of that, I'm going to agree with what CEO is recommending because I'm going to get good bonus. Or else because of the influence made by the CEO, if you agree and if your professional judgment is compromised, objectivity is going to be affected. Okay. So objectivity means you do something to achieve something. You inflate the profit to get a bonus, or else it can be a different scenario. You do manipulation to the financial statements to get a promotion, next promotion. You are eyeing for the next promotion. Because of that, you do whatever your boss says. Then your professional judgment is what? Compromised, right? So here it appears that CFO would also benefit from the manipulating financial statements due to year-end bonus. If this is the case, objectivity is more relevant as the CFO should not allow any conflict of interest. Further, extent of influence by CEO would also influence CFOs to act wrongly, which again results in lack of display of objectivity. Influenced by the CEO, intimidation by the CEO, which results, it's a kind of an undue influence, so which again may result the professional judgment of the CFO to be compromised, lack of objectivity. Are we clear with that? Always say that this particular fundamental ethical principle have been breached, right? So this is why it is breached, and these are the relevant threats to that particular fundamental ethical principle. Are we clear? Right. So we discussed about the, now if I go back, so for this particular question, integrity is applicable, objectivity is applicable, right? What about the next one? Professional competency and the due care. Can you say something about this particular fundamental ethical principle? Yes, you can easily say, because whenever there's an involvement of an accounting standard, you can easily say that if CFO doesn't know when to recognize the revenue. As per SLFRS 15, he doesn't have the professional competence. So always you can relate the particular point to the question, saying that like this. If I go to the answer, so this is this particular para, even you can take or consider as a general point for any answer. You can put this para, but only thing is you need to change the number of the accounting standard. If CFO is unaware of the requirements of SLFRS 15, then it could be argued that he is not complying with the ethical principle of professional competency. If he doesn't know SLFRS 15, if he doesn't know when to recognize the revenue, so that means what? Professional competence is what? Questioned. So that's why the professionals, even after becoming a chartered accountant, so you need to go through this CPD program, continuous professional development program. You need to satisfy a certain number of hours that you spend to develop yourself, right? Learning is not yet completed after even becoming a chartered accountant, right? Until you die, you need to learn, right? Continuous professional development, right? Okay, then tell me, this is done. What about the fourth one, confidentiality? Is this violated in this situation? Is this violated in this situation? Hurry up. Confidentiality. It seems that in this particular situation, there's nothing relating to the confidentiality, right? Because confidentiality means you reveal something without having the proper authority to do so. Now, here in this particular situation, there's nothing like that. Okay, so that means confidentiality is not applicable to this particular situation. Okay, confidentiality is not applicable to this particular situation. But the fifth one, professional behavior, is applicable. What does that mean by professional behavior? I told you professional behavior means you need to adhere to the rules and the regulations, as well as you should not discredit your profession. Now here, accounting standards are rules and regulations. So if you are a company, you must prepare the financial statements as per the accounting standards. If you don't do that, so there's a violation of a regulation. You can't do that. As well as, if you do that, you discredit the profession. Because let's say, what if you do this and the public get to know? Then they don't only blame you, they blame the accountancy profession. That discredit the profession, right? So that is also applicable here. CFO should comply with applicable professional standards and the regulations, and avoid any act that discredit the profession, right? So this is actually the professional behavior. If the CFO follows the CEO's instructions to overstate the revenue, he would display lack of what? Professional behavior, right? This is yet again, this particular para you can consider with minor modification as a general answer to any questions, because you have to adhere to the accounting standards and you should not discredit the profession, right? So that's how in this particular question the fundamental ethical principles are getting violated, and I highlighted the relevant threats to these fundamental ethical principles when I'm discussing the answer. Then finally, what sort of actions, what sort of safeguards that the CFO has to take here, okay, to reduce or to eliminate these threats or avoid manipulation of the financial state? First thing that you do is go and explain. CEO clearly, you can have a cup of tea with CEO and you can say nicely here, when preparing the financial statements, we can't do in the way that we want. So there are accounting standards which you need to adhere. You can explain him the requirements of SLFRS 15 and say that not to make any adjustments or refrain amending the interim financial statements. We'll show what is the true and fair picture about the performance of the company, right? But let's say after you explain, CEO is not going to accept what you say, right? Then you have to go to the next level, which means you might need to speak to the board of directors. You might need to go to the audit committee if you have one in the organization, and you might need to have a chat with the internal and the external auditors. You have to go to the next level, especially board and the audit committee, right? And also you have things like, even in CS Sri Lanka, you have a hotline, ethics related hotline, ethics related matters can be put into CS Sri Lanka, as well as you can get a advice from CS Sri Lanka. And even you can go to the extent of seeking the legal advices. If nothing comes to work, let's say you after trying everything, there's no other solutions, you might need to resign as well, because you are a professional. So how the accountancy profession is different to certain other professions is you are not only acting or working for the organization that you are employed, but you have a public interest. You should remember that. Okay, right. CFO should first explain the requirement of accounting standards to CEO. He should attempt to persuade CEO to refrain from amending the financial statements. If CEO further insists on suggested amendments to revenue, CFO should consider his position and bring this matter to the attention of audit committee, board, and the internal and the external auditors. If CFO still has to face the issue, he should seek the advice from CS Sri Lanka. Are we clear? So this is how you answer to the question. So did you understand the question and the answer? So it's a good question to understand the entire thing with regard to this professional ethics. So the most important area of the professional ethics is covered in this question, and I, without just just answering to the question, I just wanted to give you background as well. That's why I explained about the 5 fundamental ethical principles, threats, as well as the safeguards in general, and then moved into this particular answer. Hope you understood. Right. Any questions you can ask, or else we can move to the next question. All good? Right. So I will share this tutorial. So this particular tutorial, because I'll be moving to the next tutorial with the next question. So I'll share this particular tutorial as well as the next tutorial with CS Sri Lanka. So they will share the same tutorials with the students. Don't worry, you don't need to write down anything. Right. Okay. Moving on. So seems that you don't have any questions, right? Great. Understood everything. Fine. Okay. So with that, this particular tutorial is done. And I'm moving to the tutorial number 2. Tutorial number 2. This is part 2. Okay. Right. So let's read the question. Question number 5, ratio analysis. Yet again, continuously, there's a question, 10 marks question from ratio analysis, even in this mock exam paper. So the same pattern is followed. So there's a 10 marks question from the ratio analysis. What you need to do is here you have to compute certain ratios, and you have to do analysis and interpretations about the computed ratios. Okay, right. So what you can do is, so let's read the question. I'll give you a couple of minutes. Read the question by your own first and see these numbers. See these numbers. Okay, hope you have gone through and look at this as well. So what is the requirement? First of all, let's look at the requirement. Compute the following ratios for both years. You have to compute the ratios for both years and comment about the profitability and the operating efficiency of the company. Okay, you have to compute ratios for both years and comment on the profitability and the operating efficiency of the organization. So what are the ratios to be calculated? GP ratio, then the percentage increase or the decrease in quantity sold in the year 2020. Or there's a specific question here. What is the quantity sold increase or decrease in year 2020? Then you need to calculate or compute ROCE, return on capital employee ratio, as well as the asset turnover ratio. Right. If you look at the question, following information has been extracted. from the financial statements of Uniproduct Limited. So the name of the company is Uniproduct. You have been given the numbers of 2020, that is the current year, with the comparative numbers for 2019. Okay, sales, it has gone up, cost of sales also increased, GP has gone up, right? Then absolute terms, right? Gone up in the sense absolute terms. You have to look at the ratios and calculate and see that relative impact. Then operating cost has declined. That's a good sign. Okay, GP increased, but the operating cost has come down. Then profit for the year before tax. That means profit before tax figure. Again, it has gone up. So that is actually gross profit. Now, if you look at 2020, gross profit is 14,300. Operating cost is 7,200. Your profit for the year, sorry, profit before tax figure 7,100. That is 14,300 minus 7,200. Profit before tax. Okay, profit before tax. So even in the last year, 13,600 minus 7,800, your profit before tax 5,800. So here, normally operating cost means what are the expenditure? Administration and sales and distribution, right? Selling cost, right? So normally what you consider as the operating cost is after gross profit, administration and sales and distribution related cost. It seems that in this question, you have not been given any finance cost, right? Because normally what happen is you have the gross profit. Once you deduct the operating cost, that is administration and the sales and distribution cost, you get the operating profit or the profit before interest and tax. Then from that profit before interest and tax, you deduct the interest, then only you get the profit before tax. But it seems that in this question we don't have any figure in terms of the finance cost. Okay, you don't have any figure, so that is not given. So that's why gross profit minus operating cost, straight away you are given the profit before tax figure. Then profit for the year after tax. So the difference between the profit before tax and the profit after tax has to be the tax expense. Okay, so the current year, profit before tax 7,100, profit after tax 5,000. Last year 2019, profit before tax 5,800, profit after tax 4,200. Then you have been given the capital employed, how much that the company has invested in the business. Last it was 20,000, current year 26,000. All figures are given in thousands, right? Then there was a 10% increase in the average selling prices. Okay, 10% increase in the selling prices of the products in 2020 compared with 2019. So the last year to this year, 2019 to 2020, so the selling prices have gone up averagely by 10%. So one of the reason for this sales growth, revenue growth, is this price increase. Okay, so that's why there's a requirement to calculate the volume growth. Without taking the price increase into account, what is the growth in turnover? So that is the volume growth. You have to calculate that. Okay, so these are the requirements now to calculate GP ratio. Then the percentage increase or the decrease in the quantity sold in year 2020, ROCE, and the asset turnover. And you need to comment on the profitability and the efficiency of the organization, right? Now, when you answer to this type of question, you should have in your obviously you have to calculate these four things what is requested in the question, right? You have to obviously calculate these four things. In addition to that, you might need to calculate certain other ratios that is important for you to comment the performance. Okay, comment the profitability and the operating efficiency. Can anybody tell me, before looking at my answer, can anybody tell me what are the other important ratios that you need to calculate as workings to comment about the profitability and the operating efficiency? Can anybody tell me? Hmm? What else that we need to calculate? Hurry up, hurry up. If you are answering for this particular question in the exam, what else would you prefer to calculate? Normally, what you do is your comments or the analysis and the interpretation starts from ROCE, because that is, I would say, the most important ratio for any business, whether you earn enough return for your investment. Okay, you should earn enough return for your investment. ROC, return on capital employed. For your capital invested, employed in the business, what is the return? Now, when calculating ROCE and when commenting about the increase or the decrease of the ROCE, always you need to look at the breakdown of the ROCE. What is the breakdown of ROCE? Operating profit margin and the asset turnover. Because how to calculate the ROCE, if you look at ROCE, return on capital employed ratio. How to calculate that? I would say operating profit. That is, I would say profit before interest and tax, or else operating profit divided by capital employed. Sorry, capital employed. This is your ROCE. ROCE is equal to two things: profitability and the efficiency. What is profitability? Operating profit margin, right? I would say operating profit margin, OP margin. That is profitability. How to calculate the OP margin? Profit before interest and tax divided by revenue or sales. I would say revenue. I'm telling a general thing, right? Before moving to the specific answer, because what you need to answer to the exam in the exam would be different to this question. So these general things are important, right? Operating profit margin is the PBIT divided by revenue. So into, right, asset turnover. Asset turnover. Asset turnover measures the efficiency. Some people refer this as net asset turnover. So how to calculate the asset turnover? You take the revenue as the numerator, divide by the capital employed. All of you understand what is operating profit margin, right? So as a percentage of revenue, what is your operating profit? Always good to have a higher operating profit. Then asset turnover means for 1 rupee investment in capital, how much of revenue that you generate? For 1 rupee investment in capital, how much of revenue that you generate? So always again better to have a higher revenue for 1 rupee capital invested in the business. So the operating profit margin measures the profitability. This measures what? Profitability. Asset turnover measures the efficiency. So this particular question is testing about the profitability and the operating efficiency. So the approach to the question has to be, when you are commenting, calculations will perform. When you are commenting, your approach should be, first of all, you talk about ROCE. What has happened to ROCE? Comparing with the last year, has it gone up or has it come down? Right? You can comment about that. Then you can say why it has been changed. What is the impact on profitability? So let's assume ROCE has gone up. Let's assume. Then is it because of the profitability increase or is it because of the efficiency increase? Right? So then you can say that, okay, it is because of the profitability increase and these are the reasons for the increase in the profitability. Or else it is because of the efficiency increase and these are the reasons for the efficiency increase. So always you have a good foundation when you do the commenting or analysis and interpretation if you follow this approach. So which means now in this particular question, even though you were not requested or required to calculate the operating profit margin, what I would do is, when I answer to the question, I calculate this as a working. Okay, then I can easily comment and interpret the numbers, ratios, what I'm going to calculate, because you have to calculate first and then you need to comment on that. Then depending on the way that the analysis is going, I may need to calculate certain other ratios. I'll tell you that particular one more ratio I'm going to calculate here as working. That particular ratio I will explain once I go through the answer. I hope you understood about it, right? I hope you understood about it. Right. So with that knowledge, let's move to the answer now. But once I move to the next slide, you will understand what is the other working that I'm going to calculate. So you can think of by yourself at this moment, okay, can I guess what would be the other working? But you know now. Okay, so just focus on the first part first. I'm going to calculate the ratios. I'm going to calculate the ratios. So what are the ratios that are requested to calculate in the question? GP margin. So how to calculate the GP margin? Gross profit divided by sales, right? So you have been given the numbers in the uh, question. So based on these numbers, I'm going to calculate. So if you look at 2020, gross profit figure is given 14,300, revenue or the sales 46,200, gross profit divided by the sales, the ratio is GP margin is 30.95% in 2020, right? So then 2019, actually I have taken these numbers directly from that particular table. So 2019 gross profit 13,600 divide by the revenue or the sales in 2019 43,900. So the GP margin is 30.98. So if you look at GP margin, so it is almost same, right? So 30.98 in the last year, 2019, 2020, 30.95, right? That is simple and straightforward. Okay, easy mark, right? Then you need to calculate here percentage increase or decrease in quantity, right? Quantity sold in 2020. So in this particular question, it was mentioned that, right, there was a 10% increase in average selling prices of the products in 2020 as compared to 2019, which means this particular revenue figure, sales figure, includes 10% of price increase. Volume increase means without increasing any price. Okay, what is the quantity sold change? So to calculate the volume increase, what I need to do is the impact of increase in prices, which is included in this figure of 46,200, you have to take it out. Then you compare that with the last year sales figure, because last year sales figure is without the price increase. Okay, 2019 number 43,900 without the price increase, but 2020 number 46,200 with 10% price increase. So how to take the price increase out? If you take 46,200, right? If you, this is with the 10% increase, if you divide this by 1.1, right? Because this is actually now 110. If 2019 number is 100, 2020 number is 110. So what you do is once you divide this by 1.1, you eliminate the impact of the price increase. So what is the answer? 46,000, 46,200 you divide by 1.1. It is how much? 42,000, right? This is the sales figure. This is the revenue figure in 2020 without the price increase. Now to calculate the volume change, now it's very simple. What you do is 42,000 is the revenue figure without the price increase in 2020. From that you deduct 2019 revenue figure 43,900. You take the difference, divide this by the last year figure 43,900. Base has to be always the last year. You take the change, divide by the base. Base has to be the last year. Now, how much? 42,000 minus 43,900. You take the change, divide by 43,900, which is how much? It's a decrease of 4.33%. So the volume actually declined by 4.33%. Okay, price increase is 10%, volume reduction is 4.33%. So as the price increase impact is higher than the percentage reduction in volume, sales figure has gone up. But the volume actually in this company has come down by 4.33%. One of the reason for this volume drop may be because of the price increase. Once the price is increased, customers bought less amount. Okay, that is normal in a business scenario. Okay, right. So that is the requirement, second requirement. Actually, I showed you how to calculate that. Even here, I have included the same thing. So to calculate the percentage change in volume, take the revenue figure in 2020, 46,200, divide that by 1.1. Then you take out the impact of increase in prices minus last year sales figure, right? 43,900. Take the difference and divide by 43,900. So it's a decrease, a reduction in volume by 4.33%. I have calculated this as well. Are we clear? I hope you understood. I hope you understood. Right, great. Then what? ROCE, that is straightforward. Profit before interest and tax divided by capital employed. But in this question, I told you, you have not been given any interest cost. So your profit before tax figure and profit before interest and tax figure is same because no interest is given. If the interest is given, you have to uh, take the profit before interest and tax, right? So you have to take profit before tax plus interest. But here, as interest is not given, your profit before tax and the profit before interest and tax is same. So my numerator of the ROCE computation is profit before tax, which is 7,100 in 2020, divide by capital employed figure of 26,000. If you look at 2019, profit before tax 5,800 divided by 20,000 worth of capital employed. Take the numbers, 7,100 divide by 26,000, ROCE 27.31% in 2020. 2019, 5,800 divided by 20,000, 29%. You see ROCE, important ratio, has what? Come down. There's a deterioration in ROCE. Once you see that, okay, ROCE has declined, when you comment, you should identify whether ROCE has declined because of the reduction or the decline in the profitability, or whether it is because of the decline in the efficiency. So once you calculate the operating profit margin and the asset turnover, you have the answer there, right? Okay, right. We have calculated the ROCE. That is the third thing that I need to calculate in this particular question. And the fourth and the final ratio is asset turnover. Asset turnover is calculated, as I mentioned, your revenue divided by the capital employed. So this is straight away, you can take it from the question. Revenue figure in 2020, 46,200. Capital employed we looked at earlier, 26,000. So 46,200 divided by 26,000, 1.78 times. This is in times. Okay. What was the interpretation that I have given? For 1 rupee investment in capital employed, how much of revenue that you make? So here, 1 rupee investment in capital employed, you generate 1.78 rupees of revenue. Okay, 1 rupee investment in capital generate 1 rupees and 78 cents of revenue. So what is better? Always having a higher asset turnover ratio is better. Okay, because if you can generate more revenue for your capital employed, that is better for the company. So if you look at 2019, yet again, we know the revenue figure, which is 43,900 divided by the capital employed we looked at earlier, 20,000. So 2019, uh, how much is the asset turnover? 2.20. That is 1 rupee investment in capital, 2 rupees and 20 cents revenue have been generated in 2019. Now you see the issue. ROCE has come down. One reason for the decline in the ROCE is what? Decline in the asset turnover. Asset turnover has significantly come down, 2.20 to 1.78. It's a significant decline. right? Okay. Then, as I mentioned, for you to comment about ROCE, it is always better that you calculate your operating profit margin, this particular figure, profitability. Then you can easily comment about the change in the ROCE. So that what I'm doing is, even though it is not required in the question, I calculate my operating profit margin as a working. So how do we calculate the operating profit margin? You take your operating profit or the profit before interest and tax. Yet again, in this question, you have not been given any interest. So that profit before interest and tax is equal to profit before tax, which is how much? 7,100 in 2020, right? 7,100 in 2020 and 5,800 in 2019. You divide that by the respective revenue figures: 46,200 in 2020, 43,900 in 2019, right? So the 7,100 divided by 46,200, operating profit margin 15.37% in 2020. If you look at the last year, 5,800 divided by 43,900, 13.21%. Now you see actually what has happened to the profit margin, what has happened to the business profitability. It has gone up. It has gone up. Now your ROCE is coming down. Then you know what is the reason for that. Because I told you ROCE is the breakdown of the profitability and the efficiency. What has happened in this question? Profitability has gone up, right? But the efficiency has significantly come down, which caused to reduce your ROC. So you have the comment here. You have the comment here. Okay, you have the analysis here, interpretation here. Then the other thing that you need to know is, let me give this is a very important hint when you are answering for the ratio analysis question. So these are easy marks, right? Ratio analysis questions means pretty easy, right? If you know the examination techniques, right? This is very important thing what I'm going to tell you now. When you interpret the ratios, when you write the analysis in the exam, you should be smart. What does that mean? Now, let's say when you are writing the analysis, don't say that. Example, if I think about the ROCE, now last year ROCE is 29%, this year 27.31%. Let's say you are writing a statement like this in the exam. ROCE of the company has come down from 29% to 27.31%. You put a full stop, that's it. Are you getting marks? No, right? Because examiner can read what you have computed. You don't need to write the same thing again in the analysis. You're just saying that ROCE has come down from 29% to 27.31%. No value addition. So in the exam, because of that, what you need to remember is these two important points. Always say that if a particular ratio has been changed, whether it is a significant change or an insignificant change. Now about the gross profit margin, what you can say? It's a insignificant change, right? Almost same. Right? But about the asset turnover, you can say it's a significant decline. Always try to highlight that. Second thing is imagine or always mention that what are the possible causes for this change. That's why I told you, when you want to interpret about the ROCE, for you to explain what are the possible causes for the decline in ROC, in this case ROC has declined. For you to explain the possible causes, you should know what has happened to the profitability, what has happened to the efficiency, right? So the possible reason for the decline in ROCE in this particular question is because of the what? Deterioration of the efficiency, asset turnover, right? Asset turnover has declined. It's a significant decline. And also not stop your analysis from that particular point. You can think of why the asset turnover has declined. You can comment about possible reason. You don't know the exact reason. What are the possible reason for the decline in the asset turnover? Right? Similarly, you can say that profitability has gone up. Profitability has gone up compared with the last year. Because if you look at this working, operating profit margin has gone up. It's a significant increase. Again, what is the possible cause for this significant increase in the operating profit margin? What is the possible now think about yourself. Let's say I'm asking a question. Now I'm asking you, here you have calculated operating profit margin has gone up. What are the possible causes? What you can look at when the operating profit margin goes up? Immediately look at what has happened to your gross profit, because operating profit means what? Revenue minus cost of sales, you get the gross profit. Then from that you deduct the operating cost like administration cost, selling and distribution cost, you get the operating profit margin. Always when you comment about the operating profit margin, relate that to gross profit margin. You can go and see that, okay, what has happened to gross profit? Actually, operating profit margin has gone up, but gross profit is almost same. Then gross profit increase is not the reason for the operating profit margin increase. Normally, in a particular company, operating profit margin goes up because gross profit has gone up. But in this question, you can conclude that even though the operating profit margin has gone up, that is not because of the increase in the gross profit. Gross profit is same, right? Even though you have taken a price increase in the current year, gross profit margin is same. What is the reason? Revenue increase is proportionate to the cost of sales increase. Once the revenue is getting increased, right? Revenue has gone up in absolute terms, but proportionately cost of sales have also gone up. So that's why your gross profit margin is what? Constant, right? Your gross profit margin is constant. On the other hand, your volume drop, there's a volume drop that we have calculated 4.33%. That is actually compensated by the price increase. Price increase might be the reason for this volume drop. So somehow or the other, so even though the sales have gone up, your cost of sales have gone up by the same percentage. So because of that, your gross profit is constant. Then what is the reason for the operating profit margin increase? That's why I calculate this second ratio under the workings to find out, to prove that this is because of why my operating profit margin has gone up. What do I calculate? I calculate the operating expenditure as a percentage of sales. Operating expenditure means what? Administrative expenditure, selling and distribution expenditure. The difference between the gross profit and the operating profit. If you look at the question, how much of the operating cost that you incurred in 2020? 7,200, right? That divide by sales, 46,200, right? Then 2019, operating cost 7,800 divide by 43,900. Calculate these two numbers. Operating expenditure as a percentage of sales, 7,200 divided by 46,200, 15.58%. Last year, 7,800 divided by 43,900, 17.77%. Now here you have the answer for the increase in the operating profit margin. Your operating expenditure compared to the sales have come down significantly, right? 17.77% to 15.58%. So that caused to have a higher operating profit margin despite of having a constant gross profit margin comparing with the last year, right? So you see, always you say whether something is significant or insignificant, as well as you say what is the possible cause for this change. Then it earns you marks. Then you can get the full marks, right? Now I discussed about the ROCE. I discussed about the profitability, operating profit margin, why it has gone up. Okay. Then about the efficiency. About the efficiency, what did I say? Efficiency has come down. Why? 2.20 has come down to 1.78. Okay. What is the main reason for this decline? Again, you say that it is a decline 2.20 to 1.78. It's a significant decline. It's almost, a decline of 20% decline. We look at the number, we look at the answer in a little while. It has come down. Then what would be the possible reason? Can anybody tell me? So if you can tell the answer to this one, you are a student who analyzed the situation properly. Right? You can now relate the whole scenario to this particular answer. That is, now think about the numbers that you take to the computation of the asset turnover. What is your numerator? Revenue. Okay, revenue is generated throughout the year. 46,200. What is the denominator? Capital employed. So during this year, you have invested, right? So within this business, capital employed has gone up by 20,000 to 26,000. And when you are computing this ratio, you take the revenue figure throughout the year, but capital employed figure at the year end. You are taking this 26,000 from the year end balance sheet, right? Right? If it is taken from the year end balance sheet, sometimes I don't know exact, figures are exact situation is not given, full information is not given. Sometimes this decline in the asset turnover may be because I don't know exactly, you have invested in these assets maybe latter part of the financial year. So the assets have not contributed to the revenue generation of the full year. When you go to the next year, the situation can be changed. Let's say you have done the investment in assets only at the last month. Now, if you have done the investment in the last month, asset figure include the full amount, but the revenue contribution of these assets is not there for the full year. This can be the reason. This may be the reason. You don't know. You don't know. Sometimes I might be wrong. So the investment in the assets have been done at the beginning of the year. Then, assets were there for the full year. It has contributed to the revenue for the full year, right? You don't know exactly when this investment is done. So as I mentioned, always think about what are the possible reason for this change. So there's no end for the ratio analysis, right? I can talk about this particular question for another 30 minutes, not required. Okay, you can go into the depth of the analysis. So if you write what I say, now I explain to you the things, no? So you will get more than 10 marks, right? You don't need to go up to this level. But I told you what are the all possible analysis that you can do to this particular question. So with this question, what you should understand is, okay, how to do the analysis, how to carry out a meaningful analysis and put a answer which you can score more marks in the examination, right? So with that note, let's look at the answer. Let's look at the answer and see how the answer is compiled. That is important. I first of all comment about the ROCE and see how I have put the things into the picture. ROCE has come down by 1.69 percentage points. That is what last year it was. It has come down by 1.69 percentages. Last year 29%, current year 2020 27.31%. You put it that. ROC has come down by 1.69 percentage points, that is 27.31% minus 29%. It represents an decrease in return by as a percentage. I mentioned whether it is significant or insignificant. As a percentage, it is 5.83% reduction. How did I get this 5.83%? Percentage change is 1.69. That is the difference between 29% and 27.31%. You take 1.69%, divide by the last year ROC percentage, 29%. So it is significant, right? More than 5% comparing with the last year ROC figure. It's a significant change. Even though in 1.69 in percentage points, if you look at that comparing with the last year number, it's a 5.83% decline. So see, rather than just saying ROCE has come down by come down from 29% to 27.31%, rather than telling like that, see the first bullet point which I put, for you to earn marks. So this particular method of answering you can apply generally. You can remember this particular point for your analysis, what you do for the examination. When you comment about the ROC, you can follow this approach. That would give you marks, right? Okay, then ROCE is a coefficient or combination. It is the actually result of the profitability and the efficiency, which I explained to you. Then you go to the profitability. You explain the profitability. Despite the fact that GP margin has remained almost constant. Okay, GP margin, no change, almost constant over the 2-year period. Operating profit margin has increased here. Operating profit margin has increased significantly. So you show the number 13.21% to 13.21% to 15.37%. But the GP margin was constant. Okay. Then you explain what is the possible reason for this increase in the operating profit margin. Mainly due to what? Decrease in operating expenditure as a percentage of sales. Why the operating profit margin has gone up? Because of the decrease in the operating expenditure as a percentage of sales, administration cost and selling and distribution cost as a percentage of sales. Then you explain why the GP margin has remained constant. GP margin has remained same due to the proportionate increase in sales is consistent with the cost of sales. Sales as well as cost of sales has gone up by same percentage. That's why your GP margin is constant. Right, moving on. And always relate your analysis interpretation to the situation given in the question. Now in this particular question, one of the key highlight that is given by the examiner is there's a 10% selling price increase. Relate that particular point to the analysis answer. What it says, selling price has increased by 10% in 2020 compared to 2019, which may have resulted in a drop of volume in 2020. So we calculated there's a decline in volume. How much? 4.33%. This may be because of the increase in selling prices. That is normal, right? Once the selling price increase, there can be a demand drop. The volume drop seems to be compensated by the price increase, which allow company to maintain the same GP margin. Even though there's a volume drop, company was able to maintain the same GP margin because that particular volume drop is getting compensated by the price increase. Okay, you see, you rather than say GP margin is constant from last year to this year, you talk about the GP margin. It is constant, yes, that's true. So then you explain what are the possible reason for that. One is your revenue and the cost of sales has gone up by the same percentage, right? That's straightforward thing. Then you relate the particular point highlighted in the question to the analysis. That is, even though there's a volume drop, there's a price increase. So the volume drop should have been compensated by the price increase, so that company was able to maintain the same GP margin. Are we clear? Right. Then about the efficiency. So the other component of ROC is the what? Asset utilization. That is the asset turnover. Here company has had some concern, that is decrease in sales per 1 rupee invested by. What is the decrease? It's significant. What is the decrease? 19.09%. What is that? That is because last year 2.20, current year 1.78. So if you take the difference 1.78 minus 2.20, you take the change and divide by the last year figure 2.20, it's a what? 19.09% decline, significant decline. You take the difference 1.78 divide minus 2.20, that is the change last year to this year, divide by the last year figure, multiplied by 100. So it's a significant decline. That is a concern for the company. Okay, rather than you just stop from that particular point. What you can say is you can put another thought to the table, which you don't have the perfect answer, but you can put that particular point to the table. What is that? This may be, you see, when you are not sure, use the word may. This may be due to the fact that assets that have not been operating for the full year, which needs to be further investigated. If you don't know something, always use the word may, and also you can say that which needs to be what further investigated. When did this investment was made in the assets? Is it at the beginning of the year? Is it at the end of the year? The matter comes actually when you calculate the ratio. When you calculate the ratio, now asset turnover, if you have taken the revenue throughout the year and the capital employed at the end of the year, then there's a mismatch. So that's why some people are arguing that when you are taking the capital employed balance sheet ratios, balance sheet numbers, you have to take the average numbers rather than taking the year end capital employed. If you take the average capital employed, that is year end figure, beginning of the year figure, add them together, divide by 2, then you can solve that issue. Then the revenue is throughout, and rather than taking the year end number, you are taking the average capital employed. Then you don't have the matter what I have mentioned in this last bullet point. Okay, right. So that's all what I need to tell in terms of this question. So did you all understand? Did you all understand? Are we all okay? Now, did you understand the way that you need to analyze and interpret a particular scenario? Hmm? Let me know. Let me know, guys. Hope it is clear. Alice mentioned it's clear. Then I know that you got it. Is that okay? Right. Okay. Right. Okay, it's clear. Very clear. Right. Great to know. Right. Okay, any questions here in this question? Any questions here? No? No questions. Right. Okay. Then let's move to the next question. Then there's an important point what I want to make here. That is now number 6 of this particular paper, mock exam paper, is the consolidation question. You are requested to prepare a consolidated statement of financial position, right? You are requested to prepare a consolidated statement of financial position. Actually, what I did was I have done this question with certain amendments because to cover all the necessary adjustments in relation to the consolidation that you need to know under the examination scenario. Because what I actually did was I have made certain amendments to the dates as well as names of the companies, and I have actually incorporated 2 more adjustments to the question given in the mock exam paper, right? And also when I am discussing the question, I have not just answered to this particular question, I also looked at the possible scenarios. For an example, here when there's a sale from there can be a intercompany sale from parent to subsidiary. So that is the requirement of the question. But when I'm explaining the answer, I have looked at what if subsidiary is selling the goods to the parent. Okay, then in this particular question you didn't have this what you call these differences in the current accounts, goods in transit and the cash in transit adjustment, that was not there. So what I did was I have incorporated an adjustment. So basically in this particular question, what I have highlighted in this blue color are the adjustments what I have incorporated into the question in addition to what is there in the question. Based on that only I have answered to the question. So I have actually prepared the consolidated statement of financial position as well as the relevant workings have been shown clearly for your reference. And this particular discussion is a bit of a long discussion. As I mentioned, I have incorporated the additional adjustment and I'm discussing the all possible adjustments what is learned to the consolidation balance sheet question in the exam. Bit of a long discussion. Because of that, what are we doing is there's a recorded video for this question. There's a recorded video for this question that would be uploaded to YouTube by CS Sri Lanka today in the evening, right? So what you need to do is you have to watch that particular recorded video relating to this question, relating to the consolidation question. So which will be uploaded by CS Sri Lanka Online Academy through their YouTube channel. So is that clear? So because of that, I'm not going to discuss this question as an live online session. So this question can be watched by that particular video, including the additional adjustments. So is that clear with you? So the I will share the Excel answer. I have already shared the Excel answer with the institute, right? So they will share all the tutorials as well as Excel sheets with the students after the session today. Don't worry about that. I will also follow up. So that's how I'm going to do with regard to the consolidation question. So the next question I'm going to discuss this question number 7 after a small break. So what we can do is we can have a 15 minutes break. After 15 minutes break, we can discuss the question number 7 of this mock exam paper. That is a very important question, 20 marks question, because if you look at your paper, we now completed section 1. Section 1, you have 10 questions, right? You have 10 questions. If I go to the structure, which I have shown in the shown in my first session, so we have now discussed actually section number 1, which has 10 questions, 2 marks each, objective test questions, which we discussed and completed. And section 2 we have fully completed. There are 4 questions, 10 marks each, mini scenarios. This is done. Now I am moving to the section 3. Section 3, you have 2 questions. Out of that, 1 question is consolidation. For that, there's a recorded video which will be uploaded by CS Sri Lanka in their YouTube channel, which you can watch later on. And the second question is mainly from the accounting standards. So what I'm going to do is after the break, I'm going to discuss the question relating to accounting standard. Very important question. The important standards like, SLFRS 15, LKS 37, SLFRS 5, LKS 34, that is interim financial statement, not regularly tested, but that is also there in this particular question. So these things we can discuss after having a break. So let's take a 15 minutes break. After 15 minutes break, I will take up the question number 7 of this paper. And also if you have doubts, you can clarify by using the chat box, or else you can even speak and clarify your doubts if any. Okay, right, let's have the break then. Right. Let's start. So, as I mentioned, so I think somebody's mic is switched on. Please keep it muted. Right, great. Thank you. So as I mentioned, this particular consolidation question, which includes a subsidiary and associate preparation of consolidated statement of financial position, will be available in CS Sri Lanka Online Academy YouTube channel. It discusses all the possible consolidation adjustments, including additional adjustments. What is not there even in the mock exam paper have included to cover the entire stuff with regard to the balance sheet, right? And even the first part or the part one, actually the session, live online session which I did last week, is also available in the YouTube channel. If you missed out the session, you can watch the recorded video of the first session as well. Okay, right. And the other thing is all the tutorials, like two PowerPoint presentations and this Excel sheet of the consolidation question, I will share with CS Sri Lanka, and you can, so the educational division will share that with the students. If not, please contact the Aruna in the educational division to get the relevant materials, right? That's the message what I want to pass. Okay, with that note, let's move to the question number 7, okay, of the mock exam paper. Right. So in this question, actually, there are three parts. There are three, I would say, complex scenarios are given. You need to explain about the application of the accounting standards in relation to these three scenarios. Actually, the first part, Roman number 1, is tested from LKS 37, provisions, contingent liabilities, and the contingent asset standard. Now, if you look at the uh, now, before reading the question, as I mentioned, always look at the requirement. What is the requirement in this question is to advise on the potential claims in its financial statements for the year ended 31st March 2022. There are certain claims, right? You have to talk about, advise about the potential claims for the year ended 31st March 2022. As I mentioned, for this particular matter, for this particular scenario, what is applicable is LKS 37, provisions, contingent liabilities, and contingent asset standard. Right. By keeping the requirement in mind, let's read the question. SPLC is a listed entity. So our company is SPLC, which is a listed entity, has completed preparing the draft financial statements for the year ended 31st March 2022. Following matters remain unresolved and approached your firm expecting the technical advice for the matters given below. And you are currently working as the assistant audit manager of the firm, and you were assigned as currently working as the assistant manager. Basically, so SPLC has some technical matters to be clarified. They have referred that to a audit firm to get the accounting advice. So that as the audit manager, you need to advise for these particular matters. So basically, ultimately, what is required is you are given a scenario, right? Seems to be accounting standards not have been followed properly. You have to advise what is the correct treatment as per the relevant accounting standard. Okay, right. Let's look at the Roman number 1. SPLC builds, develops, and operates airports. So this is their business. They build, develop, and operate airports. During the financial year 31st March 2022, a section of an airport collapsed, and as a result, several people were hurt. Okay, so what is the incident? Section of the airport collapsed, and as a result, several people were hurt, got injured. The accident resulted in the closure of the terminal and legal action against SPLC. Right? This accident resulted in what? Closure of the terminal. There's a profit loss because you have to close down the operation of the airport, and there are legal actions have been taken because SPLC is the company which which has done the construction part of this airport. So the legal actions uh, Seems that it has been taken. Then, when the financial statements for the year end at 31st March 2022 were being prepared, the investigation into the accident and the reconstruction of the section of the airport damage still in progress, and no legal action has yet been brought in connection with the accident. Okay, so the legal actions are not yet being taken, but there can be a situation of taking the legal action. The situation, you need to assess the situation at the year end. What is the situation at the year end when the financial statements are prepared as at 31st March 2022? Very important to understand the situation at the year end. Investigation into the accident and the reconstruction of the section of the airport damage still in progress. It is in progress, and no legal action had yet been brought in connection with the accident. Okay, so the construction work is still in progress, investigations are still in progress, and as at the year end, no legal actions have been filed. The expert report that was to be presented to the civil court in order to determine the cause of accident. Okay, expert report was to be presented to the civil court in order to determine the cause of the accident and to assess respective responsibilities of the various parties involved was expected within 2022. Now this company's financial year end is 31st March 2022. It seems that expert report about the investigations, then the results of the finding to be presented during the year 2022, because you have another 9 months period, right, in 2022 after the year end, starting from 1st April to 31st December. During this period, this particular report to be released. Okay, that would determine the cause of accident and respective responsibilities of various parties. Okay, because yes, SPLC is the company who build this particular airport, but maybe in the expert report, after doing the investigation, uh, there might be a situation to find that yes, SPLC in guilty or else some other party. This has happened because of a mistake done by not by SPLC but by somebody else. So those results have not yet been released by the year end. Investigations are still carried on. It is in progress. Reports have not yet been issued. So once the report is done by the expert, that would be presented to the civil court to determine what is the reason for the accident and who are the responsible parties. Okay. Financial damages arising related to the additional cost and the operating losses relating to the unavailability of the building. So the financial damages, two things. One is to do the reconstruction, there's an additional cost to be incurred. Then you had to close down the terminal. So because of that, there are loss in operating profit losses, as well as additional cost to construct the airport back again. So these are the financial damages. The nature and the extent of the damages and details of the compensation payment had yet to be established. Another important information: nature and the extent of the damage and the details of the compensation had yet to be established. It's not yet finalized. Directors of SPLC felt that at present there was no requirement to record the impact of this accident to the financial statement. This is the view of the directors. What is their view? As the things are not yet finalized, right? As the things are not yet finalized, no requirement. This is very important. No requirement to record the impact of this accident to the financial statement. This is the view of the directors. So you need to advise whether it is correct or incorrect by giving the reference to the particular accounting standard. Entity has entered into compensation agreement with the victims. All the possible compensation payments are covered by the insurance policy of SPLC. This is an important point. What is that? If there are any compensation to be paid, all these possible compensation. Now, if the court decide that the company SPLC is in guilty, SPLC has to pay these compensations to the victims, affected parties. Good thing is all these compensations are protected, covered by their insurance policies, because you have something called product liability insurance that the company can take. If something happens because of your mistake, and if you need to pay damages to the customers, third parties, so that is protected against an insurance cover. So if you need to pay damages, company believe that I can claim the same amount from the insurance company. But yet again, insurance company would do an investigation. If the company has violated the insurance policy, insurance company is not going to pay. They clearly, look at the reason, whether the company is in gross negligent, have they complied with the insurance contract, insurance agreement. If so, the insurance company would pay, but the company think that okay, they can get these claims from the insurance companies, whatever the compensation to be incurred by the company. Insurance company will reimburse the compensation payments to SPLC subsequently. This is what I mentioned. Once the compensation is paid to the victims, insurance company will reimburse the compensation payment to the SPLC subsequently. Right. So what is the question? As mentioned, you need to advise about financial reporting treatment followed by the company with regard to these potential claims in the financial statements for the year ended 31st March 2022. So what company has done is, company has not recorded anything. What company has done was, so no requirement to record the impact of the financial statement. This is what directors believe. Is that correct? Is that correct? So that is the point on which you need to provide your advice. Think about it by yourself. Take 1 minute and think, okay, is that correct? So what should I do? So all of you know applicable standard is LKS 37, provisions, contingent liabilities and contingent assets. Right, before straight away jump into the answer, let me explain the relevant theory back again, because it's important to understand the theory, then you can logically understand the answer. As per standard, so for you to make a provision in the financial statements, because in this particular scenario, the first thing that the company has to look at is whether I should make a provision for the compensation payments in my financial statements, because it has not yet been paid. But if I found guilty by the court and I have to pay compensation, should I make a provision for that? Okay, you can't just make provisions, you can't make big part provisions as you wish, because the standard says that, LKS 37 says that for you to make a provision in the financial statements, all these three conditions are to be met. Number one, there should be a present obligation as a result of a past event. At the moment, you have an obligation. You don't have any other alternative but to settle this obligation. You have a duty to settle this obligation. Okay, because of a past event. Past event can be the accident which has happened. That has happened. There's a past event. Do I have a present obligation? That is the question to answer. So this present obligation can be a legal obligation or a constructive obligation. We look at what is legal obligation as well as what is a constructive obligation in a little while. Then the second condition, all these three conditions are to be met. Outflow of economic benefits are probable. What is probable? More likely than not. More than 50% chances they are to happen the outflows. Now, according to the facts given in the question, yes, it seems that there's a bit of an issue, but whether the outflow is probable, that is something which management has to decide. Management's professional judgment is important in this situation to understand whether the outflow is probable. More than 50% chances they are to occur the outflow. Right, we'll discuss again about this probability in detail in a little while. As a third condition to be met is amount can be estimated reliably. Rupee value of the obligation, rupee value of the outflow, I should be able to measure reliably. So if all these three conditions are satisfied, provision is recognized as a liability and I need to make the relevant disclosures in the financial statements. Right? So this is the first thing that you need to understand here. And as I mentioned, now let's look at in detail what do you mean by legal obligation. Actually, legal obligation derive either because you have entered into a contract with somebody else, or because of a violation of law or legislation of the country. Let's say you are violating the environmental protection legislations in the country. Okay, so because of that, you have to incur certain expenditure. So then you need to make a provision, as well as legal obligations derive because of the court decisions, court cases. Court has decided you are in guilty, so you have to incur these, you have to pay these compensations to the victim. So then you have to make a provision because you have a legal obligation, right? Normally, legal obligation is, something which you can understand easily. Contract, law, legislation, or because of a court case. On the other hand, constructive obligation means you create a valid expectation in the minds of somebody else, right? About you would undertake certain responsibilities. Okay, you are creating a valid expectation in the minds of some other party that you would discharge certain responsibilities. So because of that, you have to make a provision in the financial statements. So if I give you examples, actually you have been given here three scenarios, three examples where a constructive obligation would arise. Number one, established pattern of past practice. Let me quickly explain. Let's say if you are a seller of the electrical equipment, what you do is when you sell something, if something happens to the items that you sold within 1 year, you do a free repair. Here you don't enter into any contract, no agreement, but because of the practice that you have followed during the last 10 years, customers know that if something goes wrong during the 1 year period, they can always come back and ask for a free repair. So by following the pattern of past practice, you create a valid expectation in the minds of the customer that you would discharge certain responsibilities that create a constructive obligation on you, right? That is an example for this one. Next one, it would be a published policy. That means, let's say you say that you are an environmentally friendly entity. You published environmental policies in your website, then you advertise that, you put that in the newspapers, right? So you have published policies for the environmental protection. Now, let's say if you have done some damages to the environment, even though it is not a legal requirement, people believe that because you have published environmental policies, people believe that you would make the rectification work, right? By publishing the policies, you created a valid expectation in the minds of the people that you would undertake certain responsibilities, discharge certain duties. That yet again creates a what? Constructive obligation. Or else it can be a sufficiently specific current statement. Now let's say if I take this particular scenario into account, as soon as the accident has happened, your board of directors has called a press conference and they said that, okay, whatever, yes, there's a issue. So irrespective of the court order, whatever it happens, we would make the compensation payments to the victims. Sufficiently specific current statement is made by your board of directors, and it is done by a responsible party, not by a union leader or anyone. Right? So sufficiently specific. So who has made the statement is important, and what conditions that statement is made is important. Sufficiently specific current statement, right? So yet again it creates a constructive obligation. So then the first thing that you need to understand when you're answering to the question, you need to look at, okay, whether there's a present obligation or not, right? Then the second thing is whether the outflow, let's say sometimes you have obligation, but the outflow of economic benefits are not probable. Okay, outflow of economic benefits are not probable. So these are actually the percentages what I wanted to tell you now. So these are certain guidelines that you can follow. If something is 95% or more, you say that it is virtually certain. Then something is more than 50%. Again, I am highlighting more than 50%, not 50%. More than 50% it is probable, and this is the only thing what is defined in this standard LKS 37. How it is defined, more likely than not, more than 50%. Then possible means 50% or less. 50% or less is possible. Remote means 5% or less. So as I mentioned, only thing what is there in the standard, what is defined in the standard is probable. Others are industry guidelines. Okay, right. Okay, now that is about the provision, right? So to make a provision, all these three conditions, estimated reliability is very simple to understand. The rupee value should be able to measure. So this is the rupee value of the obligation, right? So that is about the provision. But this standard is not all about the provisions. To understand the accounting treatment that you require for this particular question, you should also understand what is contingent liabilities, under what scenario the contingent liabilities are derived, and should I need to consider this particular situation as a contingent liability. That also you need to look at. So a lot of people don't 100% understand correctly what is contingent liability, right? Let's try to understand, because there are two types of contingent liabilities. I'll relate this particular two bullet points to the scenario what is discussed in this question, right? Contingent liabilities. So first type of contingent liabilities is, it's a possible obligation. You know what is possible? 50% or less, not more than 50%. Possible obligation arising from a past event to be confirmed by future events not wholly within the control of the entity. Okay, possible obligation arising from a past event to be confirmed by future event which are not within the control of the entity. Example, let's say now if you take the same scenario, if you take the same scenario, now SPLC, your company has done the construction, then there's a collapse of one of the terminal, some issue has been happened, then you believe, yes, it has happened, but I am not in guilty. It is because of somebody who has done some blunder, not because of my construction. So after doing the construction, the whoever used this particular terminal has not used this properly, right? I'm not in guilty. I have done my job perfectly, but still, okay, that is your thinking, right? That is your thinking, but still, whether there's obligation or not to be confirmed by a future event decision of the court after looking at the export report, after looking at the findings of the investigation. So it is to be confirmed by a future event not within your control. So the court decision is not within your control. And the obligation is possible because you believe that you have done okay. There's no issue in my side, right? It's a possible obligation only. Did you understand the point? So that is the first type of contingent liabilities. Then the second type of contingent liabilities is, it's a present obligation arising from a past event, which means you now after looking at the scenario, you know that okay, there's some issue from your end. When you are doing the construction, you have not followed the standard, it seems. So you accept that you are in guilty. So there's a present obligation. But when you consult your lawyers, you have to consult the lawyers, no, because they are the one who knows about the law and interpret about it. Lawyers said that even though you are in guilty, we have a room to defend. So only 30% chance is there for you to lose the case. Then there's a present obligation. You have done something wrong. You know that. But the outflow of economic benefits are not probable. 30% chance is there to lose the case. It is not probable. Right? That means basically, I told you earlier, to make a provision, all these three conditions are to be satisfied. Right? But let's say if the first condition is satisfied, right, and the third condition is satisfied, that means there's a present obligation as well as amount can be estimated reliably. Let's say in this particular situation, even you can estimate this is the amount of compensation to be paid if I found to be guilty. But when I consult the lawyers, lawyers said that only 30% chances they are to lose the case. That means, can I say that the outflow of economic benefits are probable? No, this is not satisfied. Then this is a what? not a provision, because to make a provision, all three has to be satisfied. This is a CL. CL means what? Contingent liability. Are we clear? Or else the situation can be like this. First condition is satisfied. There's a present obligation. You know that you are in guilty. You have done something wrong. When you look at the outlaw of economic benefits, when you consult the lawyers, lawyers said that there's a 70% chance for you to lose the case. 70%, more than 50%, it is probable as well. But the amount of the damages are so difficult to estimate. It is uncertain at the moment, depending on the expert's opinion. Expert opinion is required. You can't estimate the amount. Okay, you can't estimate the amount. Now, yet again, what is this? Because to make a provision, all three has to be satisfied. Then yet again, this would become what? Contingent liability. Because if it is contingent liability, accounting treatment is just a disclosure. You can't recognize. You make a disclosure about the particular contingent liability and make an estimate, right? If possible, you make a estimate. If possible, there can be a situation, certain contingent liabilities, you can't make a reliable estimate, because now if you look at the second scenario, you can't estimate them more reliably. Then you need to mention that it's a contingent liability and I can't make a reliable estimate. If possible, now if you look at the second scenario, sorry, if I look at the this particular scenario, this particular one, first scenario, and I refer this as the second scenario. This is first, this is second. If you look at the second scenario, you can't make a reliable estimate. But if you look at the first scenario, you can make a reliable estimate, but as the outflow of economic benefits are not probable, you consider that as a contingent liability. Then what you do is you need to disclose about it and mention what is the possible amount. What is the possible amount that you might need to incur if this would become an obligation? Amount of the estimate you need to disclose. I hope you are clear about that now. Okay. So if I read it now, the second type of contingent liabilities is it's a present obligation. That means first condition of making a provision is satisfied. It's a present obligation. There's a present obligation. Legal or constructive obligation is there. But either the second point or the third point, out of the second and the third point, one factor is not satisfied. There's a present obligation, but the outflow of economic benefits are not probable, or else amount cannot be estimated reliably. So because of that, it has become a contingent liability. Okay. Present obligation arising from a past event of which outflow of economic benefits are not probable, or second condition is not satisfied, or third condition is not satisfied. Amount cannot be measured reliably. Are we clear? I hope you understood about it. I hope you understood about it. And the accounting treatment for the contingent liabilities is not to recognize the contingent liabilities in the statement of financial position, but just to make a disclosure, about the contingent liability, unless otherwise the probability is very remote. Okay, unless otherwise it is remote. Remote means what? Equal or less than 5%. You need to make a disclosure about the contingent liabilities in the statement of financial position, right? Then the third item, what is discussed in this standard, is contingent asset. In this question, the insurance claim can be considered as a what? Contingent asset, right? So what is a contingent asset? It is a what? Possible asset arising from a past event to be confirmed by future event not wholly within the control of the entity. In this case, to get the insurance claim, first of all, the court decision should be against the particular company. Now the court decided the company is in guilty. Company has to pay the compensation. Then insurance company would do an evaluation whether the company has followed the requirements what is mentioned in the insurance policy. How they fulfill the requirements. So if the requirements are fulfilled, insurance company would be making a payment to the company. So it's a possible asset. Okay, not confirmed, possible asset arising from a past event which is to be confirmed by a future event. Okay, decision of the court as well as decision of the insurance company, which is beyond the control of your organization. Right? I hope you understood about it. Then before moving there, this particular table actually summarize the accounting and the necessary disclosure requirements with regard to the liabilities and assets with different probabilities. Now, the first thing is probability of outflow or inflow with regard to a liability outflow, with regard to a asset inflow, degree of probability of outflow or inflow of resources. If something is virtually certain, that means 95% or more, virtually certain. Then if it is a liability, you have recognized the liability, as well as if it is an asset, you need to recognize the asset. Liability provide, asset recognize. Virtually certain, that means it is reflected in the financial statements, both in the case of the liability as well as the asset. Then this concept of prudence come into play. What do you mean by prudence? If it is a liability, if it is a loss, you recognize that. Okay, you make a provision for that. Okay, you are worried about it. But if it is an asset or a gain, unless otherwise it is confirmed, realized, you don't want to take into the financial statements. Okay, so the financial statements are prepared prudently. Now, probable means that more likely than not, more than 50% chances there to happen something. Let's say the probability is 70%. If it is a liability, you recognize it, you provide for the liability. But if it's an asset probable, there's a 70% chance for you to receive something. It is probable. But if it is an asset, you don't recognize it, you just disclose it. Liability provide, put the number into the financial statements. But if it is an asset, you don't put the number into the financial statement, you just make a disclosure. This is the prudence, right? Similarly, with regard to possible, let's say there's a 30% chance of happening something. If a liability is there, if it is possible, what you do? You make a disclosure, contingent liability disclosure. But if the asset is possible, 30% chance is there to get the insurance claim. 30% chance is there to get the insurance claim. Are we disclosing? No disclosure. Again, prudence. The remote equal or less than 5%. If a liability is remote, no disclosure. Asset remote, obviously, no disclosure. That's why I said that contingent liabilities are to be disclosed in the financial statements unless otherwise the probability is remote. If it is remote, even though it's a contingent liability, you don't disclose. Right? Now, this is explained what is there in the table in detail. If it is a contingent liability, should not be recognized in the financial statements. You don't recognize the contingent liabilities, but should be disclosed in a note unless the possibility of transfer, the economic benefit is remote. Okay, if it's a contingent liability, you disclose unless otherwise possibility of transferring the outflow of economic benefits are remote. On the other hand, about the contingent assets, we discussed contingent assets are not generally recognized in the financial statements, right? But if the possibility of inflow of economic benefits are probable, if the inflow is probable, then what you do, you just disclose. Probable, disclose, not recognize. On the other hand, if the asset is possible, no disclosure. Obviously, remote, no disclosure. Asset is disclosed only if it is probable. Now, with regard to the insurance claim, to disclose the insurance claim in the financial statements as a contingent asset, it has to be probable. If it is possible or if it is remote, no disclosure about that even. Okay, applying to the particular scenario. Again, is virtually certain. If something is virtually certain, if it falls within the definition of an asset, then it has to be recognized. Then it is not a contingent asset. If something is virtually certain, it's an asset, not a contingent asset. Recognize that in the financial statements. Right. So I have given a good, introduction to the particular area relevant to the question. This is very important area. Regulators in the examination, you should know, in and out about how to classify something as a provision, contingent liability, contingent asset, right? Different degree of probabilities, virtually certain, probable, possible, remote, need to have a very good understanding about that. It can be tested in a, it can be tested in section 1, section 2, or section 3, in any place of the paper. Right, okay. Right, now apply the particular scenario to the theory what we have learned. What do you say? What do you say? So first of all, you need to now decide whether a provision is required. Okay, if it is not a provision, should it be a contingent liability? So what do you say? If I go back to the case once again, okay, so you can spend 1 minute here, read it again and tell me, should I provide, or is it a contingent liability, or should it be a different accounting treatment? What I'm going to do with the insurance claim? Take 1 minute and read it again. Okay, hope you read. And this is the next slide. Okay, what do you say? So is these three conditions are satisfied to make a provision? That's the answer. As at 31st March 2022, at the year end, Greeny, the company has no legal obligation. Okay, because there's no court case filed. Okay, no legal obligation to pay the compensation to third parties. No legal action have been brought in respect of the accident. That means there's no legal obligation, because if it's a present obligation, either there should be a legal obligation or else constructive obligation. So constructive obligation means what? Have you created a valid expectation in the minds of the other people you would discharge certain responsibilities according to the situation and the facts given in the question? Because why? By the year end, investigations have not yet been concluded. Export report is not yet available. So because of that, you can't say, you don't have sufficient evidence to say that there's a constructive obligation at the year end, right? No, can Greeny be said to have a constructive obligation at the year end? Okay, there's no constructive obligation as well at the year end, because why? Investigation has not yet been concluded. So you have to justify your answer. Why do you say that there's no legal or constructive obligation? Investigation has not yet been concluded. Export report will not be presented to the civil court up until 2022. That is in up until future, because financial year end is over by 31st March 2022. Therefore, under LKS 37 provisions, contingent liabilities and the contingent asset standard, no provision would be recognized for this amount, as you don't have a present legal or constructive obligation. Are we clear? Are we clear? Right. Then there's an uncertainty as to the outcome of the investigation. Okay, uncertainty. So this uncertainty talks about the degree of probability of the cash flow, because you need to look at whether the degree of probability is virtually certain, probable, possible, or remote when deciding the accounting treatment, right? So the uncertainty means it talks about the degree of probability. So there's an uncertainty about the two things: outcome of the investigation, whether the investigation would say that the entity is in guilty, and also finding of the expert's report, right? And also there's an uncertainty about the extent of damages amount. Can we measure the amount reliably? Okay, extent of the damages, and any compensation arising remains to be confirmed. So, so you are uncertain about the outcome of the investigation. You are uncertain about the finding of the reports. You are uncertain about the extent of damages as well as amount of the compensation which you are going to receive from the insurance company. A lot of uncertainties are there, right? Now, what do you say? Now we concluded. This is how you logically think. Now you concluded with regard to the liability. Obviously, it is not virtually certain. And also we concluded that liability is what not. You don't have a liability because why? There's no present obligation. As well as because of so much of uncertainties, I can't say that this is actually a what? Probable situation. There are a lot of uncertainties exist. But now the decision is about whether this uncertainty is a possible obligation or a remote obligation. By looking at the facts, it seems that you can't say this is remote, right? Because you have done the construction and there are investigations going on. Experts are looking at. Okay, so there are of victims. So these grounds are not warrant to say that it is remote. Actually, when looking at the factors, there's a judgment, right? So you have to make the judgment here. Management has to make the judgment. In the exam, you have to make your judgment. So you have to argue. Why do you say? Why do you arrive that conclusion? So it seems that this is a what? Possible obligation. So if it is a possible obligation, what you do is you just need to make a disclosure about the particular obligation, as well as you have to make a uh, estimated impact assessment and say that if the obligation arise, if I need to pay, this is how much that I need to pay. But you don't need to recognize a provision in the financial statements. I hope you understood about it. Now, if you look at the answer, however, the uncertainty about these details is not so great that the possibility of the outflow of economic benefits to be remote. So even though the uncertainties are there, you can't say it is remote. Okay, it doesn't warrant that it is remote. Therefore, as a contingent liability, this is a contingent liability. Details about the liability as well as the what possible estimate of the amount payable should be disclosed. It has to be disclosed in the notes to the financial statements. Ultimately, what is the conclusion? It's a contingent liability, possible obligation. You have to disclose the details and the possible estimate about the amount payable in the notes to the financial statements. So you derive the conclusion step by step. You say that first of all, it's not a provision. Then it's not remote as well. It's not remote as well. So because of that is a contingent liability which has to be disclosed in the set of financial statements. Right. Then what about the other side, insurance claim? Now I'm asking the question. Now we have, sorry, now we have reached to a conclusion when it comes to the liability. Liability is what? Possible. So because of that, what you do is you just make a disclosure as a contingent liability. That is now confirmed. What about the asset side? What about the asset side? Asset means if company found guilty and the company has to pay damages to the victims. So what company has done is to cover up these damages, company has entered into an insurance policy. Company can get the company believe that the directors believe that the company can get the compensations from the insurance company. Now you have reached a conclusion with regard to the liability. By looking at the conclusion that you have reached in terms of the liability, what do you can say about the asset? Hurry up. I'm giving you the chance to say that. So where should I say that? Where should I, is it virtually certain? Is it probable or is it possible or is it remote with regard to the asset? Hmm? Hurry up. Let's try. Let's give your thoughts. What do you think? It's your judgment with justifications. Can we say that it is virtually certain? Can we say that it is virtually certain? Can we say that it is probable, possible, remote? Now, first thing is, For you to get the insurance claim from the insurance company, you have to lose the case. Basically, you have to pay the damages, isn't it? If you pay the damages only, you are going to get the claim, right? If you don't pay damages to the victims, insurance company is not going to pay you, right? Now you have already decided the amount or degree of the probability of paying the damages to the victims are possible, isn't it? You have already decided it is possible only. Then the first thing that you have to understand is you start the asset insurance claim from that particular point. If your damage payment of the damages are possible, your assets probability starts from there. So then you can't say that your asset is virtually certain while having the liability as possible. You can't say that your insurance claims are virtually certain, as well as you can't say that your insurance claims are probable, because you say that possibility of losing the case is only possible. Then obviously getting the insurance claim should start from here. It shouldn't be over here or it shouldn't be over here, right? To get the insurance claims, you need to pay damages as well as one other thing to be satisfied. What is that? Insurance company has to agree to pay these claims. Insurance company has to say that you satisfy the requirements of the insurance policies. So it seems that when it comes the inflow of the resources with regard to this insurance claim, you are one step away from the probability of the liability. If the probability of the liability, if you say possible with regard to the asset, it has to be either possible or else it has to be remote. But you are one step away comparing with the liability, because why? To get the compensation, insurance company should agree. That's an additional requirement. Okay, so let's say if you conclude you have a 30% chance, so that's why we say that the liability is possible, right? When it comes to the asset, it has to be maximum 30% or less, right? Because it is depending on the insurance company's decision as well. So either this particular asset should either be possible or remote. But both cases, even though it is possible, even though it is remote, is there a difference in the accounting treatment? No, it's no disclosure situation. Are we clear with that? This is how you analyze and explain. Right, look at this. Question arise as to whether the possible recovery of the compensation cost from the insurance company constitutes a contingent asset under LKS 37. Is it whether it's a contingent asset or not? And if so, what is the accounting treatment? Why it says because any insurance claim will only be made after the court have determined compensation. Court decision is against you, then only you have to get these insurance claims, and will then need to be assessed on its merits. Decision has to be said that you are in guilty, as well as it has to be assessed on its merits, whether the claims are reasonable, whether the insurance company would agree. Then you can say that any payout is one step away from the potential payment of the compensation. Actually, potential payment of the damages. If you say that the probability of making the damage payments are 30%, probability of getting the compensations from the insurance company should also be maximum 30% or less. So that's why I said that it has to be either in the possible stage or it has to be either remote stage, but in both cases, no disclosure is required in the financial statements. Right. Okay. So a bit of a difficult question when making the judgment. It's a very good question to understand the entire aspect of this, different probabilities of the cash inflows and the outflows, and also the accounting treatment suggested in LKS 37. Right. That is done. Hope you all understood. If any questions you can raise, or else I can move to the part 2 of the question number 7. That is out of very important standard SLFRS 15. Revenue from contracts with customers. So the SLFRS 15, SLFRS 16, and SLFRS 9 are very important three standards, right? Regularly tested in the exam. So this paper, what I would see is you have a question from SLFRS 15, but uh, there was, objective test question in by using SLFRS 16 that was not there in this mock exam paper. But remember, for the examination, always 15 and 16 are both important, as well as SLFRS 9, financial instruments. Right. Okay, if you don't have any questions from the previous part, let's look at this question. Right. So what is required again? Comment on the views of SPLC. So you are given another complex scenario. Okay. Uh, Based on the reading of the scenario, you have to comment on the view point of SPLC. SPLC is our company. Right. I'll give you a couple of minutes. Read the question by your own first before I read it. Right. Read. Okay. Let's move on. On 1st January 2022, SPLC entered into a contract with HPLC. Our company is SPLC. They entered into a contract with HPLC for the sale of building for 300 million rupees. So it's a sale of building for 300 million rupees. HPLC, that is the buyer. SPLC is the seller. And HPLC is the buyer. HPLC intends to use the building as a fitness and a leisure center. Building is used as a fitness and leisure center. The building is located in a busy city where there are many gyms and leisure centers. Okay, so a lot of competitors are there in the business. Okay, building is located in a busy city and there's a lot of competition in this industry. HPLC, that is buyer's experience to date has been in stores selling health foods and oils and has no experience of the fitness industry. Okay, if you look at the industry experience of the buyer for this particular business, fitness and leisure business, and buyer doesn't have any experience because the previous experience is about something else, selling health foods and oil, and the buyer has no experience about the fitness industry. Okay, right, useful insights. You will find out why this information is given in the question. HPLC, that is buyer, paid SPLC a non-refundable deposit of 15 million rupees on 1st January 2022. Okay, so that means the total proceed that buyer has to pay seller is about how much? 300 million rupees. But how much it was paid on the first day? It's only 15 million. That is actually 5% of the total consideration. Right? This is 5%. How did I get the 5%? 15 million divided by 300 million, only 5%. Right? HPLC buyer paid SPLC seller a non-refundable deposit of 15 million on 1st January 2022 and entered into a long-term financing arrangement or agreement with SPLC for remaining 95% of the promised consideration. Okay, so what has happened was out of 300 million, 5%, that is 15 million was paid upfront, or that is kept as a non-refundable deposit, Remaining 95%, which is actually about remaining 90% means in rupee terms, rupees 285 million. Okay, 300 million out of that 15 million was paid. Remaining 285 million to be paid under financing arrangement, seems to be on installment basis, right? The terms of the financing arrangement are that if here there's a printing mistake, this has to be H, right? This has to be H. So I have taken this from the original paper, but there's a printing mistake. The terms of the financing arrangement are that if HPLC defaults, if buyer defaults, right? SPLC can repossess the building but cannot seek further consideration from HPLC. If buyer defaults, only thing what seller can do is he can get the building back. He can't say that buyer has to pay the remaining amount. Normally it is not the case, right? When you sell a building, when you sell something, so the responsibility of the buyer is to pay the rest, and seller can demand for the rest of the consideration. But this arrangement was made in such a way, now let's say after paying this initial 15 million, buyer, that is HPLC, has not done well. So they are new to the business, there's a lot of competition, and they don't have any experience. So because of that, they have not performed well. So because of that, buyer can't make the remaining payment of 285 million. In that case, as the seller, our company, what SPLC can do is, only thing is get the possession of the building back. Okay, nothing else. You can't demand for the remaining 285 million, right? Even if the collateral does not cover the full value of the amount owed, because sometimes the value of the building might not cover the, because this will happen on a future date. On that particular future date, when you make the, now let's say this situation would happen after 6 months. After 6 months, still maybe the entire amount or 285 million or part of this amount is outstanding, and buyer says that he can't pay, then the amount of the consideration might be higher than the value of the building at that time. At that time, we don't know. Even if that happens, only thing what SPLC can do is get the building back. He can't say that, okay, uh, with the interest, the balance amount to be paid is more than the value of the building, so that you have to pay. So the seller can't make such a request. Only thing is he can get the building back. That's why it's clearly mentioned, even if the collateral does not cover the full value of the amount owed, only thing what SPLC can do is, our company seller can do is get the possession of the building back. Uh, Building cost 180 million. In your books at the moment, building is recorded at 180 million. Sales price, what is the sales price? 300 million. It seems that if this is recorded as a sale, you are going to make a profit. Okay, let's assume cost is carrying value. I believe cost means the carrying value. Carrying value 180 million. If you sell that at 300 million, and if you de-recognize the building and recognize the sales proceed, you get a gain of 120 million. Question is, okay, can you record that profit? Can you de-recognize the building under the situation, under the conditions, what is given in the question? HPLC obtained the control of the building on 1st January 2022. That means actually, as this transaction has been entered into, HPLC is the company, that is the buyer is the company who is using the building from 1st January 22 onwards. Okay, so SPLC is having a building. So SPLC is transferring the possession or the control over the building to the buyer on 1st January 2022. From that date onwards, buyer can use this as the fitness and the leisure center. But seller has received only 15 million of non-refundable deposit, only 5% of the consideration. The remaining amount to be paid in the future. You have not been given how it is paid and during or which period it is paid. That information is not given, but it is over the period payment with the finance cost. Right. What is the question? SPLC argues that is our company, seller argues that this contract falls within the, this is the argument of SPLC. What is the argument? SPLC argues that, our company argues that contracts falls within the scope of SLFRS 15. Revenue from contracts with customers that the non-refundable deposit should recognize as revenue, as it is a as it is falling within the standard of SLFRS 15 revenue recognition standard. So company can recognize 15 million, that is this non-refundable deposit what they received, as revenue. So basically what SPLC is suggesting is to record this transaction as a sale. Indirectly what it says is if you record the transaction as a sale, you have to re-recognize the building, right? Credit building 180 million and you receive 15 million, right? Debit 15 million cash. Then you have to debit the balance amount, this 95% as a receivable yet to be received, and somehow or the other you recognize the sale of this particular building. You remove the building from the financial statements. You recognize that as a sale. So the question that you need to answer is, as per the standard SLFRS 15, can you recognize the revenue here? Whether the conditions of recognizing the revenue is satisfied or not. Or in more specifically, do you have a contract here to recognize the revenue? Right? Now, if you are a brilliant student, you can understand what is the area of the revenue recognition that is important for this question. All of us know that there are 5 steps in the revenue recognition model. I'll look at the 5 steps. So these are the 5 steps. Right? Number 1 is to identify the contract with the customer. That is the agreement that the seller and the buyer has. Agreement between the seller and the buyer. Identify the agreement. Then identify the performance obligation in the contract. What are the distinct contractual promises in the contract? Okay. So the first step is to identify the agreement to provide the relevant goods and the services. Then the second step is to identify what are the performance obligations with regard to goods. Okay, what you need to provide actually. Is it a building? So if it's a different example, let's say, is it a computer? Is it a machinery? Right? Is it FMCG products? Identify the performance obligations within that contract. Are there any service components? Do we have any, after sales services? What are the distinct performance obligations within a contract? Then decide what is the transaction price. That is step number 3, total consideration that you're going to get out of this particular contract. That is step number 3. Step number 4 is to allocate the transaction price to each performance obligations. If you just have one performance obligation, this is very simple. Allocate the entire transaction price to that particular single performance obligation. But if you have number of or multiple performance obligations, you have to allocate the transaction price to each performance obligations based on their relative standalone uh, trans relative standalone selling prices. Okay, if you have 2 or 3 performance obligations, the entire transaction price you need to allocate to each performance obligation at the contract inception itself. And step number 5 is to ultimately recognize the revenue when each of the performance obligation is satisfied. You have to look at each and every particular performance obligation and you need to understand when these performance obligations are going to be satisfied. In this standard, you have 2 approaches where the performance obligations are satisfied. Number 1, over time approach. Performance obligations are satisfied over the period of time. Then to recognize the revenue, you use the progress towards the completion. Based on the progress towards the completion, you recognize the revenue with regard to the performance obligations which are satisfied over the period of time. The other way of satisfying the performance obligations is at a particular point in time. If it is a point in time, you look at what is the point at which control is passed. At that particular point, you recognize the particular performance obligation as revenue. So I'm not going to discuss, all these 5 steps in detail. Just wanted to give you a, very high level understanding about these 5 steps. Now, the question that I'm going to ask from you is, right? The question that I'm going to ask from you is, you need to now answer this particular question. There are 5 steps here. This particular question is applicable to which of these 5 steps? Can you tell me? You have to understand the area in which the question is tested. No, now you obviously know it is from SLFRS 15. Under SLFRS 15, there are 5 steps to recognize the revenue. Now, to answer this question, which step is important? Which one should I analyze in detail? What I need to look at, when answering to this particular question? What do you say? What do you say? Which step is important to answer the question? Hurry up, hurry up. Let me know your answer. 1, 2, 3, 4, 5. Actually, what is applicable is step number 1. You have to determine, first of all, whether there's a contract between seller and the buyer. Okay, whether there's a contract. Okay, what is a contract? Contract is an agreement between two or more parties that creates enforceable rights and obligations. There can be written contracts, there can be verbal contracts, there are certain contracts entered impliedly. So some or the other, there should be an agreement between two or more parties about the enforceable rights and the obligations. So with regard to the seller, normally the enforceable right is to, collect the consideration. So the seller's obligation is to provide the particular goods or the service. On the other hand, buyer's right is to get the promised goods or the service. And the obligation is to make the payment as agreed. Okay. Now, this is actually the definition of a contract. Then this definition of the contract is drilled down in the standard and say that for you to say that there's a contract, all of these 5 requirements are to be met. Okay. So all requirements, following criteria must all be met for a contract to be identified. If all these 5 things are met, only we say that there's a contract. So look at this. And now again, now I, you know, make your life easy. I explained to you this question is tested from this question is tested from step number 1. Step number 1 is to identify the contract. For you to say that there's a contract, 5 conditions are satisfied. Now you should answer. Tell me whether all these 5 requirements are met or not. If it is met, that's fine. If 1 or 2 or maybe more criteria are not met, what these criteria which are not met? Spend, 1 minute by yourself and see that whether you can answer. No point me answering everything, right? Exam is very close by. What do you say? Look at one by one. Look at one by one. Contract must be approved by all parties. Okay, so it seems that yes, it is approved. Both parties agreed, right? I told you this approval I told you it can be a written contract, verbal contract, or implied contract. But so the first condition, Roman number 1 is met. It is approved by both parties. There's no evidence to say that parties have not approved the contract. So it is satisfied. Each party's rights regarding the goods and the services to be transferred must be identifiable. Each party should know their rights and it can be identifiable. Example, what is the right of the seller to receive consideration? What is the right of the buyer? Get the building. Okay. So I think, yes, rights of each party can be identifiable in the contract. There's no issue in terms of that aspect as well. Then payment terms must be identifiable. Yes, there's an initial payment of 5%, which is 15 million. And in the contract, you should be able to identify what are the payment terms. How are you going to pay the balance 95%? Again, we believe that that is included within the contract. So maybe is settled over the period of time, maybe over 5 years, right, in equal amounts. So again, there are no evidence in the question to say that payment terms are unidentifiable. So because of that, we believe that yes, third condition is also met. Normally, when you enter into a contract, payment terms are included. It can be upfront payment, it can be installment payment, it can be with a credit period, some or the other. For you to say that something is a contract, payment terms must be identifiable. Then there should be a commercial substance. It's a two-way transaction. Seller is giving the building, receive cash. Buyer is getting the building, pay cash. It's a transaction with a commercial substance that is also satisfied here. Number 5, it must be probable that vendor means seller, will collect the consideration to which it is entitled. Now this is a judgment. We know the word probable. What is the meaning of the word probable? More likely than not. More than 50% chances there for the seller to collect the consideration to which it is entitled. Actually, this point is applicable only for the credit sales, right? Because if it is a cash sale, upfront you receive cash. So you receive everything in the case of a cash sale. So there's nothing called whether the consideration received is probable or not. But if it is a credit sale, in this question, it's a credit sale, right? Only 5% of the consideration is received out of the total consideration. So the question is, can we say that it is probable that the seller will collect the consideration to which it is entitled? So what do you say? Roman number 5. Condition number 5 is satisfied or not, depending on the factors given in the question. Depending on the factors given in the question. It seems that there are a lot of uncertainties here, right? Because one is, if buyer can't pay, only option available to the seller is not to demand the money but to get the building back. That is one uncertainty. On the other hand, the industry is at a higher business risk, because why? This particular customer, HPLC, who is buying the building, doesn't have any experience in this industry. Okay, that is the point of view of the buyer. That is the position of the buyer. And also, this particular industry, as I said, is very competitive. It says that it's in a busy city where there are a lot of gyms and the leisure centers are operated at the moment. Can buyer, grab a percent or market share in this particular industry where he doesn't have the experience? Right. So when you look at these factors, it seems that you can't exactly conclude that it is probable that you would collect the consideration to which seller is entitled. So because of that, what happens is actually there's a question mark, or you can't conclude that criteria number 5 is going to be satisfied. If criteria number 5 is not going to be satisfied, all conditions are not met. If all conditions are not met, this is not a contract. If it is not a contract, there's no step number 1, revenue cannot be recognized. Are we clear? Are we clear? So you see the level of analysis that you do, and you should know the standard, not to. That's why it's very important for you to understand the standard logically, not to learn by heart the things. So these are the 5 steps, these are the conditions. No, that's not the way. Okay, so what you do is, now you have very short period of time to get ready for the examination. If you don't have the relevant theoretical knowledge, go back to the your class notes, maybe videos, watch them again. Even the important, at least the important areas like revenue, leases, financial instruments, get revised to your knowledge, right? So that is the purpose of this mock exam paper discussion. So definitely in exam you are not going to get the same question, but you learn how to compile an answer. What are the things that need to improve. So that's why when I'm discussing an answer, I'm always trying to relate to the other areas. What are the possible other questions that can be tested? What sort of an approach that you need to follow when you answer into the question, right? All these things are important, and that's why I'm discussing those things, right? So let's look at the answer now. Criteria 1 to 4. 1 to 4, what I discussed, have been met, but criteria 5 is in doubt. the following factors need to be taken into consideration, right? The first factor, if customer defaults, HPLC defaults, SPLC seller is not entitled to full compensation for the amount owed, but only has the right to repossess the building. That means seller can't collect the consideration if customer is not going to pay, right? And there are evidence that it would be difficult for the customer to pay. Why? HPLC, that is the customer, intends to repay the loan, which has a significant balancing amount, balance payment, that is 95% is not yet paid. Okay, customer intends to repay the loan primarily from the income derived from the fitness and the leisure center. So you have to generate income out of this fitness and leisure center to pay. Business is facing significant risk because of high competition in the industry and customers limited experience in the industry. So because of that, can you say that customer would generate enough revenue from their business to pay this particular balance amount of funds, because the balance amount is significant, 95% to be paid, right? Probably that is why this customer wants to enter into a contract to say that if he can't pay, only option that the seller has is to get the building back. So customer himself might be not sure that whether he can pay. So that's why he entered into a contract like this nature. If I can't pay, only thing you can get the building back. Right? That is the arrangement. Okay. It is therefore not probable. It's not probable that SPLC will collect the consideration to which it is entitled in exchange for the transfer of building. It is not probable. So then, how are you going to account? Can you derecognize the building? No, you can't derecognize the building. If there's no sale happen, you can't derecognize the building. You have to keep the building in the balance sheet of SPLC. And the non-refundable deposit that the SPLC has received upfront, 15 million, has to be recognized as a liability, a kind of a advance receipt, contract liability. Okay, it's a contract liability in the balance sheet. SPLC account for the non-refundable deposit of 15 million as a deposit liability. You need to debit cash and credit the liability, contract liability. Then after doing that, right, what SPLC, that is at the initial date, on the date of entering into the transaction, then date of entering into the transaction, 1st January 2022, after making these assessments, what you do is you pass an entry. What is the entry that you pass on 1st January? This is the entry. Cash debit, how much? 15 million. Credit contract liability. 15 million. Then that is on the initial date, based on the initial facts. But let's say over the period of time, when you look at the actual situation, buyer might perform well. He has a lot of good marketing initiatives, business development initiatives, and he's making money out of the fitness and the leisure center now. And he's making the payments as agreed at the beginning. Then later on, seller might conclude that here now condition number 5 is satisfied. It is now probable that I will collect the consideration to which I'm entitled. So that, which means after the initial entry, you have to look at the situation on constant basis and see that whether the criteria number 5 is satisfied. And if you believe that the criteria number 5 is satisfied, at that time, you have to derecognize the building and recognize the revenue in terms of this particular transaction. Right? So that's what you need to do. So what it says here, SPLC, that is the seller must continue to account for the initial deposit as well as the future payments of principal and interest as a deposit liability until such time that the company conclude that it will recover the compensation owing, or until it has received the substantially all of it. Up until the point where you reach to a conclusion that I'm going to get this money, it is probable for me to collect the consideration. Up until that time, it is a liability. So let's say you initially received 15 million. Let's say in 3 months' time, you received another 20 million. So then you make an assessment. Even at that time, I'm not sure. Seller is not sure. It is not probable for the seller to collect the consideration. So then the additional amount of 20 million received is also a contract liability, deposit liability. But at a particular point in time in the future, seller can conclude here, this buyer is going to pay me. It is probable for me to collect the consideration. Up until that point, always whatever the amount that you received, a contract liability. But once the probability, once you say that it is probable that for me to collect the consideration, you have to recognize the revenue, or else there can be a point where substantially all the amounts have been paid by the customer. Let's say suddenly at the end of the first year, suddenly customer has paid the most of the amount outstanding. He has done unexpectedly well. Out of 300 million, he has paid, let's assume, 275 million. Substantially all the consideration have been paid. At that time also you can decide that here condition number 5 is satisfied, I am going to recognize the revenue. So that's why, again, if I read it, SPLC must continue to account for the initial deposit as well as any future payments of principal and interest as deposit liability until such time that the company conclude that it will recover the consideration owing, or until it has received substantially all of it. So what SPLC seller has to do is, SPLC must continue to assess the situation to see if their SPLC must continue to assess the situation to see if these changes have occurred. Continuously, you need to look at the situation. Accordingly, you have to make the necessary changes of recognizing the revenue. So once the condition number 5 is satisfied, conclude that the number 5 is satisfied, you can recognize the revenue. Right. Okay, so that is the answer to that particular question. Again, very good question. You need to know in and out of step number 1 of revenue recognition model to answer to that question. So remember, not only step number 1, all the other steps 2, 3, 4, 5 are very important in the examination, and ensure that you know everything with regard to SLFRS 15, right? If not, as I mentioned earlier, look at the videos, look at the tutorials, revise your knowledge about SLFRS 15. Right? Okay. Right. Roman number 3. Last question of the mock exam paper. These actually tested out of 2 areas, mainly SLFRS 5, non-current asset held for sale and discontinued operation. In addition to that, you also need to know that uh, requirements of interim financial reporting, LKS 34 as well, right? So what we can do is, first of all, let's read the question first. Look at the question first. I'll give you 2 minutes to read the question. Read the question, and there are some numbers as well, right? I'll give you actually 5 minutes to look at the, you have to do certain computations, right? I'll give you 5 minutes to do the numbers as well, right? I'll give you 5 minutes to do the numbers. 1 second. Right, you can ready with your numbers, answers once we start the discussion. Right. Ready with the answers? Numbers? Okay. Right, let's read the question. Roman number 3. Again, the requirement is to discuss how the property in Roman number 3 above should be dealt with in the financial statements of SPLC. Okay. On 1st April 2019, SPLC acquired a property for 50 million rupees and annual depreciation of 5 million is charged on straight line basis with no residual value. What does this indirectly say? So annual depreciation of 5 million means for a property which has a 50 million cost with no residual value. So indirectly says that useful life is how many years? 10 years. Okay. Useful life is 10 years. That is what it is indirectly mentioned. Cost is 50 million, no residual value, annual depreciation is 5 million means 50 million divided by 5 million, useful life has to be 10 years. That's clear, right? Then at the end of the previous financial year, that is 31st March 2021, right? Because if you look at this question, what is the current year end? Current year is 31st March 2022. If you look at the last year end, previous financial year, 31st March 2021, when the accumulated depreciation was 10 million, that is correct, no? Because the particular property was acquired on 1st April 2019, incurred a 50 million cost, where the annual depreciation is about 5 million, right? So now when it comes the end of the previous financial year, 31st March 2021, 2 years have passed. So the depreciation for 2 years has to be how much? 10 million per annum depreciation, 5 million for 2 years, 10 million. So there's a accumulated depreciation balance of 10 million, right? In addition to that, there's a further amount relating to an impairment loss. So the particular asset was impaired by 3.5 million. That is by 31st March 2021. Then when it comes to the year ended 31st March 2021, what should be the carrying value of the particular property, plant and equipment item? This has to be a PP&E. What is the carrying value of the PP&E? So it is 50 million is the original cost, right? 50 million is the original cost which was incurred on 1st April 2019. Then you record depreciation for 2 years, that is 5 million into 2, 10 million you need to deduct, right? 10 million you need to deduct. In addition to that, you have recognized an impairment loss, that is a permanent value reduction. So there would have been an impairment indicator. Based on that, company has done an impairment testing where it was found that at the end of the second year, recoverable value is less than the carrying value by how much? 3.5 million. So that it was decided to recognize an impairment loss. What's the double entry of the impairment loss? You credit the PP&E 3.5 million and debit to profit and loss statement. Okay, you charge this impairment loss to the P&L, credit PP&E. Credit PP&E means you need to deduct that from the carrying value of the PP&E item. Okay, 3.5 million credit PP&E, debit P&L. So this has been debited to, this has been charged to P&L. So what is the value of the carrying value of the PP&E at the end of the 31st March 2021? It has to be 36,500,000. 36,500,000 after charging the impairment loss of 3.5 million to the P&L. 50 million minus 10 million minus 3.5 million. Is that clear? Up to now, everybody understood, right? Okay. So which resulted in the property being valued at its estimated value in use. I told you in impairment, what you do is you compare the carrying value and the recoverable value. So the carrying value is the balance sheet value, recoverable value is the higher of value in use or fair value less cost to sell. Here the value in use is seems to be higher than the fair value less cost to sell. So the recoverable value is 36.5 million. You write down the asset value up to 36.5 million for the year ended 31st March 2021. So the point what I wanted to make is at the end of the previous financial year, 31st March 2021, carrying value of the PP&E item after recognizing the impairment loss, it was 36.5 million. Right. Up until that, the situation what it was happened in previous financial years, right? Because for you to do the computations for the current year, actually you need to know the last year closing number, and this would be the current year brought forward figure. So that's why I spent little time to explain depreciation requirements and the impairment requirements which have been recognized, entries which have been passed in the previous financial years, because this is the starting point, brought forward value of the PP&E item in the current financial year, that is for the year ended 31st March 2022, because this would be ultimately the opening balance in the current financial year, which is 1st April 2021. Okay, last financial year closing balance is equal to the opening balance of the current financial year. Now what has happened in the current financial year? On 1st August 2021, okay, that is after 4 months, right? April, May, June and July, after 4 months of the current financial year, as a consequence of proposed move to new premises, the property was classified as held for sale. Here what has happened? Earlier we were using this property in the business, so the company has occupied this property. But now company has decided on 1st August 2021 to move into a new premises. With that decision, this particular property that you are using now classified as held for sale. I'm going to sell this particular property. So what you should apply? What is the standard? SLFRS 5, non-current asset classified as held for sale and discontinued operations. So in that particular standard, non-current asset classified as held for sale, you are given what are the classification requirements of assets as held for sale. Classification requirements: upon satisfaction of what conditions an asset is classified as held for sale. Then it explains the measurement requirements of held for sale assets. What are the initial measurement requirements and what are the subsequent measurement requirements of held for sale assets. And also it discusses, SLFRS 5 discusses presentation requirements of held for sale asset. How are you going to present the held for sale asset in the statement of financial position? So the SLFRS 5, this is for your knowledge, right? SLFRS 5, SLFRS 5. Okay, I'll write it over here. SLFRS 5 discusses three things with regard to the assets classified as held for sale. HFS means held for sale. What are the three requirements? What are the classification requirements? What does that mean? Upon satisfaction of what conditions should I classify the asset as held for sale? Now in this case, earlier it was a property, plant and equipment. Now from 1st of August, I might decide to classify this as held for sale if the classification criteria are met. What are the classification criteria? What is the condition? Primary condition of classifying an asset as held for sale is entity is going to recover the carrying value of the asset principally through a sales transaction. Normally you recover the carrying value of the assets not by sales transaction but by using the asset in the business. But if you are trying to recover carrying value principally through a sales transaction, you say that you have to classify this particular non-current asset as held for sale non-current asset. Then this detailed criteria of what is the detailed criteria? You are going to recover the carrying value principally through a sales transaction. This particular primary criteria is further drilled down into two sub criteria. For you to say that you are going to recover the carrying value principally through a sales transactions, two conditions are to be met. What these two conditions are? Number one, the particular asset should be available for immediate sale. If some buyer comes at the price expected by the seller, you should be able to give the particular asset immediately. You can't say that, okay, it will take another 2 months time for me to think to make the movement into the new property. So because of that, even though it is on 1st August, I can't give the particular property to you today. I will give you in 2 months time. No. Or else you can't say that, okay, there are some repair work to be done, I'll complete and give it to you after 2 months. No. So it should be available. Okay, it is, if somebody asks now, you should be able to give it to that particular buyer now. It is available for what? Immediate sale. Now you can give it. As well as sale should be what? Highly probable. You know the word probable, right? More likely than not. It is not probable even, highly probable. Maybe 80%, 85%, 90% chance is there to happen this sale. So then there are some sub criteria to look at. What do you mean by sale is highly probable? There are conditions to be looked at to determine whether the sale is highly probable or not. I'm not going to go into those. So what I want to tell you is, if the asset is available for immediate sale, and also if the sale is highly probable, then you say that this particular asset's carrying value you are going to recover principally through a sales transaction. Classification criteria of SLFRS 5 is met, so you can classify the asset as non-current asset classified as held for sale, right? Okay. Then SLFRS 5 also discusses about the measurement requirements. When it comes to measurement requirements, what are the initial measurement requirements? What are the subsequent measurement requirements? So which we need to look at. So in this particular question, actually what we are going to target is this particular area. Initial measurement, how it happens, and subsequent measurement, how it happens. Then let's say by the year end, if you have not yet sold the asset, okay, by the year end 31st March 2022, if you are unable to sell the asset is with the entity, and that particular asset is an asset classified as held for sale, how are we going to present that in the financial statement? That is presentation requirement. Okay, you have to present the non-current asset classified as held for sale separately in the statement of financial position. You can't include that under PP&E. You have to separately show that under current assets. Why you show under current asset? Because you are going to dispose that asset in the near future. Your principal intention is to recover the carrying value through a sales transaction, so that it has to be separately presented as a current asset in the statement of financial position. All these things are discussed in SLFRS 5. Okay. Right. I went, in depth again for your knowledge. On 1st August 2021, as a consequence of a proposed move to new premises, property was classified as held for sale. So we believe that classification criteria are met by 1st August 2021. At the time of classification as held for sale, that is on 1st August 2021, fair value less cost to sell was 34 million. At that date, initial date of classifying the asset as held for sale, what is the fair value less cost to sell? 34 million. Then at the date of published interim financial statements, this company is preparing the interim financial statements. So the interim financial statements are prepared at the middle of the year, 1st October 2021. Okay, so companies preparing their interim financial statements 1st October 2021. That is at the middle of the financial year, because what is our financial year? 31st March 2022. 1st October 2021 means exactly the middle, after 6 months from the starting of the financial year. Property market has improved. property market has improved, and the fair value less cost to sell reassessed to 35.2 million. Here on 1st August, when it was classified as held for sale, fair value less cost to sell 34 million. Then at the date where you prepare your interim financial statements on 1st October 2021, fair value less cost to sell has gone up to 35.2 million, right? And at the year end, it seems that even up until the year end, it is not yet sold.